My name is Mr. Mariga Bernard, and I'll be teaching you Advanced Management Accounting. Specifically, the topic I want us to talk about is the topic known as planning and decision making. Once we cover planning, or one of the items we are going to cover planning and decision making is this particular subtopic known as CVP models under conditions of uncertainty. CVP models under conditions of what? Uncertainty. In our previous session, we talked about CVP models under conditions of certainty, where we said under conditions of certainty, the factors affecting cost volume profit analysis are known with certainty. Some of these factors include the selling price per unit, the variable cost per unit, the fixed cost, the units produced and sold. These factors that affect CVP are known with what? Certainty. But there are those circumstances when these factors may not be known with certainty, where the user of information may not be certain or may not be sure about the selling price of a product. They may not be sure about the variable cost of a product. They may not be sure about the fixed cost. They may also not be sure about the demand that our customers are going to demand for a particular what? Product. When the factors affecting cost volume profit are not known with certainty, we introduce the concept of CVP models under conditions of uncertainty, what sometimes we also refer to as stochastic models of CVP. Stochastic models of CVP. For us to study these CVP models here under conditions of uncertainty, we are saying it is where one or more factors affecting CVP and profits are not known with certainty. Are not known with certainty. Certainty. For us to be able to deal with CVP models of uncertainty, we must be given probability. Probability in terms of chance. You may be given the probability of selling price, of various selling prices, the probability of various variable cost, the probability of demand, and so on and so forth. These probabilities are normally obtained from prior experience of the user, from previous observations. So allow me to introduce one of the methods that we are going to study as far as this particular topic is concerned. The first method I want us to talk about, or among the methods, let me write here, let me just highlight the methods here, then talk about each one of them. Methods of under conditions of uncertainty. Under conditions of uncertainty. So these are the methods we normally use to study cost volume profit analysis, or the relationship between costs, volume, cost, profits, revenues in relation to the volumes. Number one, the first method is what we refer to as expected value method. That is the first method. The second method that we will use to study this is simulation method. Simulation. We may also have sensitivity analysis. Sensitivity analysis. Number 4, statistical analysis. Number 5, probability tree. Diagram method. Then continuous or normal distribution method. Normal distribution methods. Normal distribution method. So these are the various methods that we are going to study so that we understand CVP, where one or more factors affecting profit and CVP is unknown. So number 1, let me start by highlighting this method known as expected value approach. The expected value approach of CVP analysis. The expected value approach. Now, expected value simply says or simply states that the expected value is determined by taking the summation of probability, you multiply by what? X. Where PO means your who? Probability. And X may be your observation. Maybe your who? Observation. Or your variable. Let me also refer to it as your what? Variable. This variable here may be demand. This variable here may be the units. This variable here may be the profits. The variable may be the costs. Okay. So to get your expected value, you're going to take your probability, you multiply by your variable. The expected value can be denoted, can simply be denoted as X bar. The expected value is denoted as what? X bar. So we can have an illustration. Let's have an illustration on this approach known as expected value method. And the question I want us to talk about today is a question on November of 2017, question 4A. If you go to your Kasneb past papers and we go to November 2017, question 4A, question 4A. And they're saying for A, that company is known as Bipo Limited. It is known as Bipo who? Limited. Bipo Limited. So Bipo Limited is planning to launch a new product into the market. In order to determine the introduction selling price of the product, a market research was undertaken. The following information was obtained from research under two selling prices, 300 and 350 per unit. The selling price per unit, or 300 shillings, you have your probability of 0.4 and the units sold are 120,000. Probability of 0.5 and the units sold are 110,000. Probability of 0.1 and the units are 140,000. 100,000. When the selling price per unit is 350, with a probability of 0.3, your sales volume is 108,000. With a probability of 0.3, your unit's sales volume is 100,000. With a probability of 0.4, your sales volume is 94. Additional information number 1. The variable production cost would be 120 shillings per unit for production volumes up to and including 100,000 units each year. However, if production exceeds 100,000 units each year, the variable production cost per unit would fall to 110 for all units produced. Advertising cost would be 9 million per annum at a selling price of 300 shillings and 9.7 million per annum at a selling price of 350 shillings. Fixed production cost would be 4.5 million per annum. Advice: the management of Bipo Limited on the optimal selling price per unit for the new product. Advice: the management of Bipo Limited on the optimal selling price per unit for the new product. So this particular question here requires that the user or the students to advise the company on the optimal selling price that that company is going to set. The first selling price is when you have a selling price of how much? 300. The second selling price is when you have a selling price of how much? 350. So let's start with the first option. Let's start with the first option. Option 1. Let me call it option 1. When your selling price P is how much? 300 shillings per who? Per unit. 300 shillings per unit. To determine your profit, say it is P minus V, you multiply by Q units minus what? Fixed cost. That is how we determine our what? Profit. Where P is your selling price per unit, V is your variable cost per who? Per unit. And Q are the units produced and what? Sold. Units produced and sold. F is normally your total what? Fixed costs. Your total fixed costs. Currently, they want us to analyze when we have a selling price of how much? 300. We need to go and see and identify whether we've been given the variable cost. And additional information number 1. Additional information number 1 is saying the variable production cost would be 120 shillings per unit for production volumes up to and including 100,000 units each year. However, if production exceeds 100,000 units each year, the variable production cost per unit would fall to 110 for all units that were done what? Produced. So for us to be able to determine our variable cost per unit, we need to determine the units that were produced and sold. The units that were produced and sold. Because the units that were produced and sold are influencing the variable cost, such that if you sell 100,000 units, your variable cost will be 120. Anything over 100,000 units, your selling price will be 110. Right. So let's determine Q units. We determine Q units. And how will we do that? We will determine the units that are going to be produced and sold by simply taking your probability, you multiply by your sales volume. Your probability by your sales volume. Okay? much? So we're going to say 0.4 by 120,000 plus 0.5 by 110,000 plus 0.1 by 140,000. So therefore, the expected units to be sold at a selling price of 300, if you work this one out, it should be 117,000 units. 117,000 units. Therefore, now that we have the units that can be sold, we can then determine our variable cost. And they were saying for any units above what? 100,000, your variable cost will be how much? 110. 110 per who? Per unit. 110 shillings per who? Per unit. That is given by additional information number 1. We have the selling price, we have our variable cost, we have the units. Now let's determine our fixed cost. Note number 2, advertising cost will be 9 million per annum at a selling price of 300,000 and 9.7 million per annum at a selling price of 350. Fixed production cost would be 4.5 million per annum. Your fixed cost here will be given by your fixed production cost plus fixed plus administration overhead plus administrative. They are referring to them advertising, not administrative, advertising costs plus advertising what? Costs. Your fixed production overhead cost is 4.5 million and your advertising cost is 9 million. So therefore, your total fixed cost is 13.5 million. It is 13.5 million. Let's determine our who? Profit. Our profit. Your selling price is 300 with a variable cost of 110. You multiply by the units, the expected units, which we have determined as 117,000 minus your fixed cost of 13.5 million. Minus your fixed cost of 13.5 million. Therefore, for that company, or when that company sells or sets its selling price at 300, they expect to sell how many units? Or 117,000, and to make a profit of 20.88 2880,000, rather 7380. Let me confirm this again. 300 minus 110 times 117,000 minus 13.5 million, 8730. 8730,000. All right. Let's go to the second option. Option 2. When you set your selling price at how much? 350 per unit. When you set your selling price at 350 per unit, we must determine our units. We must determine our expected units to be sold by taking the probability times the units. So you're going to take 0.3 times 108,000 plus 0.3 by 100,000 plus 0.4 by 94,000 by 94,000. So 0.3 times 108,000 plus 0.3 by 100,000 plus 0.4 by 94,000. So therefore, the expected sales volumes, the expected sales volume is how much? 100 what? 1,000. 100,000. It is always good to confirm that whatever you've done is what? Accurate. Always confirm. Once you've determined our units, we then determine our variable cost. Note number 1, the variable production cost would be 120 per unit for production volumes of up to and including 100,000. So this will be 120 per unit. Your fixed cost is the next item you're going to determine. It will be 9.7 million, which is your advertising expense given by note number 2, which says advertising cost would be 9 million per annum at a selling price of 300 and 9.7 million per annum at a selling price of 350. So since our selling price is 350, the fixed advertising cost will be 9.7 plus your fixed production cost of 4.5 million. So 97 plus 45. That should give you a total fixed cost of 14.2 million. So therefore, your profit should be a selling price of 350 minus your variable cost of 120. You multiply that by your expected units to be sold 100,000 minus a fixed cost of 14.2 million. Of 14.2 million. So let's determine our profit. And the profit in this case will be 8.8 million. 8.8 million. 8.8 million. Then they are telling us to advise the company on what selling price they should set. On the selling price they should set. Remember, we had two selling prices that the company is considering. A selling price of 300 and a selling price of 350. When they set a selling price of 300, where they expect to sell 117,000 units, they are going to make a profit of how much? 87.30, compared to when they set a selling price of 350, where they expect to sell 100,000 units, they're going to make a profit of 8.8. So when we advise them, we're going to tell them to set a selling price of, set selling price per unit a unit of how much? 350. When you set a selling price of 350, you're going to set how much? You're going to earn a what? More profits. More profits. All right. That is the first method of evaluating what? Of evaluating what? CVP models under conditions of uncertainty. Under conditions of uncertainty. The expected value approach. We've said the expected value is simply the product of your probability and your variable. And remember, we've said your variable may be the units, your variable may be the variable cost per unit, it may be the fixed cost. It is basically that unknown item that affects your profit or CVP. Let's go to the second concept. Let's go to the second concept that we have covered. Let's go to the second concept, which is what? Simulation. Which is simulation. Right. Welcome to yet another session of Advanced Management Accounting. My names are Mr. Mariga, and this is Manifested Publishers. I want to talk about investigation models for what? Variances, which is still a topic under budgetary control what? Techniques. In the previous session, we talked about ex post or planning and operational variances. So today we want to do what? To talk about the various models that you can use to investigate our what? Variances. When you are investing your variances, there are certain factors you need to consider. There are certain factors you need to consider. One of the factors you consider is the size of the variance. The size of the variance. How big is it? Okay. Number two, you also want to consider the type of the standard that has been set. What is the type of standard that has been set? The third factor that will guide you as far as investigating variances is concerned is the cost that you're going to incur were you to investigate that what? Variance. The cost of investigation of the variance. Number four is the likelihood of repetition. How likely is it that the variance will repeat itself in future? So if you see that there is a likelihood that it will repeat itself in future, it is important to investigate that particular what? Variance. And lastly, you want to consider the ability of the measurement tool. How effective is it in investigating the variance? That tool that you are going to use, how effective is it? Your investigation models or tools are four. Number one, you have a rule of thumb. Rule of thumb. Number or sometimes also known as materiality. This is also known as what? Materiality model. Now this investigation model here, the investigator will basically decide on the limit that they are going to consider as material, then after that investigate. Okay, so you need to consider the limit and whether that limit is material. If it is material or it can influence the decision maker, you need to do what? To investigate. If not, do not do what? Investigate. Number 2 is statistical significant model. Statistical significant model. No. The statistical significant model is normally used, or is a model of investigation of variances where you measure the what? The variance, or you measure probability given the variance and the mean. So here you measure probability given the variance and the mean. Okay. It is such that it is a rule set on standard deviation that is allowed away from the mean. So effectively, the statistical significant model is an investigation model where you use your normal distribution. You use your normal what? Distribution. And remember, your normal distribution is a looks like that, is a model, is a probability distribution where it is correctly defined if you have the mean and you have the standard deviation. So this model here, known as statistical significant model, you simply use your normal distribution curve to investigate what? Variances. The third model is statistical quality control model. Statistical quality control model. The statistical quality control model, now it is a model where you will test variances if they do not fall within a certain tolerable limit, or if they do not fall within a certain tolerable what? Limit. For example, you may have your mean there, your mean limit, or just your mean, that is your upper control limit, and this is the lower control limit. Your lower control what? Limit. Such that if your variance falls between the upper and the lower, you do not do what? Do not investigate. Do not investigate the what? The variance. However, if the variance or your result falls below the lower control limit, there you must investigate. And upper control limit, you must also do what? Investigate. You must investigate. Okay, so you investigate. Why? Above the upper and the lower, because they are outside the tolerable what? Limit. They are outside the tolerable limit. Then the fourth model of investigating variances is what we refer to as statistical decision model. Statistical decision model, where it is a technique of comparing the expected cost of investigation and the expected benefits of investigation. When the benefits exceed the cost of investigation, you will investigate the variance. However, if the benefit is lower than the cost, you will not investigate the what? The variance. You're not going to investigate the what? The variance. You're not going to investigate the variance. So here, sometimes or in most cases, we simply use decision trees. Decision trees, where you're even going to have your states of what? Nature. Is investigate, don't investigate. Then various states of nature when you investigate, and the various states of nature when you don't do what? Investigate. Then whichever is the best, if the benefits outweigh the what? The cost of investigating, what will you do? You will simply do what? Investigate. So those are the various models that are used when investigating what? Variances. Number one, rule of thumb, where you look at the materiality, use of a normal distribution, then you set acceptable limits so that if they fall above and below, you investigate. Then statistical decision what? Models, where you look at the benefits that will accrue from investigating and the costs that will be incurred when investigating. So when the benefit exceed the cost, you investigate. If not, do not do what? Investigate. All right. Now in the next session, we will talk about the various budgetary control systems, the various budgetary control what? Systems that can be used by a decision maker or by a company when preparing what? Budgets. When preparing budgets. So goodbye and see you next time. Welcome to Advanced Management Accounting. My name is Mr. Mariga, and today I want us to talk about applications of learning curve model and ABC in variance what? Analysis, which is a topic under budgetary control and what? Control and techniques here. Now, we were tackling cost estimation and what? Forecasting and interpretation. We talked about learning curve, where we said that learning curve here is a method of estimation that takes the general form y is equals a b plus 1 and y bar is equals ax raised to power b, where b we said is your learning curve index, which is given by log learning curve divide that by log who? Log 2. X we said is the activity level or your outputs, or your who? Your output. A is a time or cost of first unit of production of who? Production. Y is a cumulative total time or what? Or cost. Y bar is a cumulative average time. Time or who? Or cost. Remember, we said that when an employee gets used to doing something, they improve their what? The rate at which they produce, and that improvement rate, where they take less time or they incur less cost than the first unit they produced, is what we refer to as what? Learning curve. Is what we introduce as what? Learning curve. And we also said that NB, your learning curve rate is simply 1 minus your improvement rate. Minus your improvement what? Rate. Right, that I've given you a brief recap of that. Today we want to talk about, or I want us to introduce something on variances, where you have what? A learning curve, where you have learning curve. And we are going to do a question of November of 2020. Let's talk about November of 2020. Question 5. Question 5. Question we will tackle today, where they're saying High-Tech Limited intends to launch a locally manufactured printer in the coming month of December 2020. The Research and Development Department of the company has provided the following information relating to the production of the printer. You have your selling price of 17,500 per printer. Variable production cost, you have direct materials of 800 grams at 7,500 per kg. Direct labor of 75 minutes at 3,000 shillings per hour. Variable overheads of 60% of direct labor hour. Then you have your contribution per printer. Production of the printer is scheduled to commence on 1st of December 2020. The company plans to produce and sell 3,000 printers per month. A direct material loss of 10% is expected, with no resale value. The annual fixed cost attributable to the production of the printer is 60 million. The cost accrues evenly throughout the year. A learning curve effect of 95% is expected. Determine the standard labor cost for the month of December. So let's start with part 1. I want us to determine your standard labor costs. Now your standard labor cost will be determined by your standard what? Labor hours. You multiply by your standard labor rate per hour. Your standard labor hours, you multiply by your standard labor rate per hour. Standard labor cost is given by your standard labor hour. You multiply by your standard labor rates. Which is in shillings per hour. Okay. Your standard labor rate, they've told us currently is how much? 3,000 per hour. But we need to determine our standard labor hours. Keeping in mind that we have what? A learning curve. So let's determine our standard labor hours. So computation of standard labor hours. Computation of standard labor hours. Your labor hours will be given by AX B plus what? 1, where A is the time for the first unit, and the time for the first unit is 75 minutes. 75 over 60 hours, which is 1.2 what? 5, which is 1.25. Then your output that you had planned to produce is how much? 3,000 units. 3,000 who? Printers. Then B, we know, is your learning curve index, which will be your log of learning curve, and your learning curve rate is 0.95 divide by log 2, which is negative 0.074. All right. So let's then determine our labor cost, our labor hours first. You're producing 3,000 printers, rather. The time of the first unit is 1.25, but you're producing 3,000 printers. Negative 0.074 plus 1. So therefore, your total labor hours that will be used to produce the 3,000 units, keeping in mind that you have a learning curve of how many? Of 95%, is that you will use 2073 hours. 2073 hours. All right. So your labor, your standard labor costs, your standard labor cost now, you're using 2073.587056 hours. You multiply that by your standard labor rate per hour, and your standard labor rate per hour was 3,000. So therefore, your standard labor cost is there. Is that 6,220,761.167. All right, that is the first part. Then they're telling us part B to prepare a budget. A budget what? Statement. Budget profit statement. Let's start with your sales. Now this budget profit statement is what sometimes we refer to as an original who? Budget, or a static budget. It is a budget where you consider your activity at the beginning and your cost at the beginning. So we normally say it is a budget of budgeted cost, but for budgeted activity. So when you're determining your sales, you're going to take your budgeted selling price, you multiply that by your budgeted units sold. Your budgeted selling price was 17,500. That you multiply by your budgeted units sold, which were 3,000 printers. Then you less your who? Your costs. The first cost will be the cost of direct materials, your direct material cost. And your material cost, we were using 800 grams at 7,500. But note number 3, this added and said, a direct material loss of 10% is expected with no resale what? Value. With no resale value. So the 800 grams, therefore, are at 90%. What about what? 100%. So what will you say? Going to say 800 over who? 100 kgs. You multiply that by who? By 100. Then times what? Your cost now, your cost in kgs was 7,500 to 7,500. Okay. You multiply by your printers, which are how many? 3,000. Then all these, or let me see, not all these. Then you divide that 100 by what? 90. What have you effectively done? This is what you've done. You've said that 100 is equal to what? 90. What about 800 over who? 1,000. How much will that? That is what we've done there. Why? Because they're telling us that you have a normal loss of 10% of the material. So even if you bring 100, you're going to get what? 90. And our material, how much at 90% is what? 800 grams. 800 grams, which is 800 what? Kgs. So therefore, at 100, how much do we expect there? So you expect what? 0.88. 0.88. So this 0.88 here, which is now this working, you multiply by the price per kg, then times what? 3,000 printers. That is your material cost. I hope that is very clear why we've worked at it that way. Okay, this, I think even that is what I should write here. So let me write that so that it is very, very clear. 0.88 kgs. You multiply by who? 7,500 per kg. But you had produced how many printers? 3,000. 3,000. All right, that is clear. You then add the cost of direct labor. Cost of direct labor. And because of the learning curve effect, your labor cost, we determined it. We determined it as 62, 20, 761.16 Then you did also have variable overheads. Variable overheads, where they were saying they are 60% of direct labor. So 60% of direct labor, 167. Then lastly, you had fixed what? Overheads. Or fixed costs attributable. For the whole year was 60 million, but you want only for the month of December. So you're going to take 60 million. You divide that by how many months? 12 months. You divide that by 12 months. 2. This is 20 million. This is 37. 324. 56.7. And lastly, your fixed overhead cost is 5 million. So your budgeted profits. This is 556. Yeah? All right. That is your budget. That is how you apply learning curve as far as variances is concerned. The next part of that question, where they're telling us to reconcile, we will do that in the next lesson, where I will introduce 3 items or 2 items. Number 1, I will introduce operating variances. I will also introduce planning what? Variances. Alright, those 2 things. But for these 2 to exist, you must have what we refer to as revised standards. You must have revised what? Standards for those 2 to be there, but we're going to talk about them in the next what? Lesson. In the next lesson. So what so far as we've been talking about is conventional variances. Conventional variances, or you simply compare standard or what? Original with actual. You're operating here, you compare your revised and your actual. This one, planning, is your standard and your actual, but we'll talk about that in the next lesson in more detail. So from me, goodbye and see you next time.
Hello candidates, and welcome back to the lesson. The subject is leadership and management. Today I will answer question number 5 from the December 2021 sitting. Question 5A reads, with reference to enterprise management, define the following terms. Roman 1, innovation, 1 mark. Roman 2, invention, 1 mark. Roman 3, creativity, 1 mark. Leadership and management, December 2021, question 5A. Roman 1, define the term innovation. Define the term innovation. To innovate. What does that mean? Innovation is the process of making changes to something that already exists. Making changes to something that already exists, or something that is already established, by introducing something new or established by introducing something new in order to add value to customers, to the organization, and so on and so forth. So making changes to something established by introducing something new that adds value to customers and so on. So innovation, in other words, is a process of making changes, whether the changes are large or small. The changes may be radical, the changes may be incremental, and these changes may be made to products. The changes can be made to the processes of the organization. The changes can be made to the services that results in introduction of something new for the organization that adds value to customers and contributes to the knowledge store of the organization. Introducing something new that adds value. So innovation may be in relation to the products that the company produces, can be the procedures, the services, and so on. 2, define invention. To invent. To invent is to create something new that has never existed. Creating something new that has never existed. When you come up with something new that has never existed, then that's an invention, to invent. Getting something new, and at times it could be something that is not even desired by customers. If, for instance, I come up with a pen like a pen that has never existed, then I'll say I've invented the pen. Coming up with something that is totally new. And that thing may never be in demand. All right? So that's invention. To invent is to come up with something that it has never existed before. Creating something new that has never existed before. Then we have creativity. Creativity. Creativity is a mental process, all right? Creativity is a mental process that results in new ideas, that results in production of novel ideas. Creativity is a mental process that results in the production or coming up with novel ideas. They could be concepts, novel ideas, concepts that are appropriate, that are useful, that are appropriate, concepts that are useful and actionable. Creativity is a mental process that results in the production of novel ideas or concepts that are appropriate, useful, and actionable. 1 mark, 1 mark, 1 mark. This is 1 mark, 1 mark, 1 mark. Part A. Part B. Analyze 4 arguments against management as a profession. Arguments against management as a profession. Is management a profession or is it not? That's the question. And if it's not a profession, then what are the arguments? The first argument is that no uniform set of qualifications, be they academic or professional, are necessary for successful management. No set of academic or professional qualifications necessary for successful management. For one to practice as a manager, one does not require specific professional or academic qualification, as is a case for a profession. For you to be called a professional, then you ought to have gone through certain academic and professional training. Such training is not required when it comes to management of organizations, because management is basically an art. It can also be seen as a practice, right? If it's a practice or an art, then minimal academic qualifications are required. That's one argument. The second argument, managers do not have unique or uniform group of clients. Unlike other professions, like doctors and so on, managers do not have a uniform group of clients. Managers are trustees of shareholders and all other groups having a stake in a company. And therefore, it is not practical to define precisely the obligations of managers. They are just trustees. They don't perform specific duties or uniform services like other clients, like say lawyers, who are professionals. So managers do not have uniform group of clients. They are just trustees of shareholders and trustees of other groups of people who have a stake in a company. Another argument is that, as we all know, professionals are bound to adhere to a certain code of conduct. In management, there is no universally accepted code of conduct. Next is in relation to entry, restricted entry. Professions have restricted entry. For one to join a profession, then there is entry requirements. The entry to a profession is restricted through academic qualifications, professional qualifications, could be years of experience, and so on. Whereas there is no legal restriction on appointment of a manager. Anyone can become a manager irrespective of their educational or professional background. So in arguing the case against management as a profession, candidates, you can answer this question by first of all looking at the what is a profession, what are the characteristics of a profession. So you measure or argue the case against management as a profession by comparing the features or characteristics of a profession vis-a-vis what happens in management. So one case is based on academic or professional qualifications or training. The second one is based on the kind of group that both serve. There is a case in relation to the code, then entry. So these are 4 arguments, 4 marks. 4 arguments, 4 marks. 4 arguments, 4 marks. Part C, discuss 4 approaches to ethical decision making. Approaches to ethical decision making. Now, what is an ethical decision? An ethical decision is a decision that is both legal and morally accepted to the larger community, whereas an ethical decision may be regarded as either illegal or morally acceptable to the larger community. That's the meaning of ethical decision or an ethical decision. On the other hand, ethical decision making can be described as the process of generating and implementing decisions that are ethical. And we know ethical decisions tend to uphold the legal and the professional standards and show respect for the relevant stakeholders. We also know that ethics is the discipline and the practice of applying value to human behavior, as well as to the constructs of human culture, particularly to morality, customs, laws, resulting in what we call meaningfulness. And from the earliest moments of recorded human consciousness, the ethical discipline has exhibited 4 fundamental approaches, which the examiner required the candidates to discuss. 4 fundamental approaches to ethical decision making. The first one is utilitarian approach. Utilitarian or outcome-based. Outcome-based approach. And this approach is perhaps the most popular or the most familiar and easiest to understand of all the approaches to ethics. And this approach asks a very important question. And this question is, how will my decision affect others? And this approach goes further to quantify the impact of the actions based on some least common denominator, like say happiness, pleasure, wealth, and so on. So utilitarians are also known as consequentialists. Consequentialists, from the word consequence, the outcome. What are the consequences? You've heard terms like choices have consequences. You've heard terms like what you reap, what you sow, you reap. Choices have consequences. Decisions have consequences. So when making ethical decisions, the utilitarians ask a very important question. How will my actions affect others? And that's why these utilitarians are also known as consequentialists, because they look to the consequences of their actions to determine whether any particular act is wrong or right. So the wrongness or the rightness of an action is dependent on the effect or the impact of that action on other people. So that is the utilitarian approach to ethical decision making. Outcome-based, consequentialist, utilitarian. The second approach, and before the second approach, I need to mention that the utilitarian motto is the greatest good for the greatest number. The greatest good for the greatest number. But we also know that defining good is not easy, not an easy task, because what some people think as good, others may think of it as being worthless or bad. For when, say, a businessman does a cost-benefit analysis, such a businessman is engaging in utilitarian ethics. And the least common denominator in such a case is money. All right? Money. Because the most familiar use of outcome-based reasoning is legislative committees in, say, representative democracies. And the utilitarian approach to ethical decision making states that one should choose the action or the policy that has the best overall consequence for all people who are directly or indirectly affected. So the goal is to find the single greatest good by balancing the interests of all the affected parties. So the utilitarian fits easily with the concept of value in economics and the use of cost-benefit analysis in business. Utilitarian approach. The greatest good for the greatest number. The number there is the number of people. The greatest good for the greatest number of people. Another approach is the deontological approach. Deontological approach, or what we call deontological ethics. Now, this approach is based on duty. This is a duty-based approach. Deontology, candidates, or deontological simply means the study or science of duty, the study of duty. And one important or one prominent proponent of deontological ethics is Immanuel Kant. Immanuel Kant, who did not believe that human beings could predict outcomes or future consequences with any substantial degree of certainty. So the ethical theory is based on guesswork about future consequences. So candidates, Immanuel Kant did not believe that humans could predict outcomes with certainty, as is case for the utilitarian approach that is based on consequences. Before you make a decision, you find out or you try to understand what could be the consequences, and based on the future outcomes, you make a decision, because that will help you know whether that decision is good or bad, whether it's ethical or unethical. But Immanuel Kant, who is a proponent of duty-based ethics, did not believe that it was possible for humans to predict future outcomes with certainty. So duty-based ethics is enormously important for mostly two kinds of people or groups: the business people, the politicians, and so on. This approach is also key to understanding better our responsibilities as members of teams. Because there are some values that should never be sacrificed to the greater good. Because we saw here the greater good could be monetary. But according to the deontological ethics, there are some values that cannot be sacrificed because they are good to people. And Kant was of the view that people should act as to treat humanity, whether in their own person or in the person of any other. And in every case, as an end, never as a means only. So human beings, you need to act from a sense of duty, deontological ethics, duty-based approach to ethical decision making. Moving on to the third approach, virtue ethics. Virtue ethics, or virtue-based approach. And virtue means the excellence of a thing. And ethics in this sense is a discipline of discovering and practicing virtue. And we can begin doing that by asking ourselves, what do people desire? There are people who desire wealth, people desire honor, they desire physical security, people desire psychological security. But you know, all these things are not an end in themselves. They are means to ends. The ultimate end for a person, this approach teaches, is the person. The person must be an end. So one of the proponents of this virtue-based approach or ethics, virtue ethics, is Aristotle. Aristotle thought that one virtue by using his unique gift of human reasoning. That is through rational contemplation. And the ultimate goal of developing characteristics of virtue can lead to true happiness and a full flourishing of self. So virtue-based ethics, or the virtue ethics approach to decision making, focuses on how you should behave and think about relationships if you are concerned with your daily life in a community. It does not define a formula for ethical decision making, but suggests that when faced with a complex ethical dilemma, people do either what they are most comfortable doing, or they think a person they admire would do. Thus you hear some Christians say, what would Jesus do in this situation? What would Jesus do? But it does not define the formula for ethical decision making. Virtue ethics. Here we talked about deontological ethics. Then utilitarian or outcome-based approach. Then lastly, the fourth approach, communitarian approach or ethics. from the word community. This is community-based. These first three approaches, the utilitarian approach, the deontological approach, and the value ethics, are principally focused on the individual, the singular conscience, rationally reflecting on the meaning of duty or responsibility, and in the case of virtue ethics, the ethical aspect and so on. But the communitarian ethics has a unique or different point of departure. It's not the individual, but rather the community. It could be, the community could be the team as a community. It could be a group as a community. It could be even the company as a community. That can also include the culture and so on. So the first three focuses on the individual. This one is community-based, within which the individual places himself or herself. So the communitarian asks the important question, what are the demands or duties that the community of which I am part of make on me? So the communitarian asks us to not simply look within to understand how values should be applied to the human conduct, but to look out and to face up to the duties of being creatures for whom social interactions are definitive. And therefore we define ourselves and our responsibilities by the company we keep. So decision and policies that use this approach attempt to implement a social system or institutions or environments that everyone depends on and that benefits all the people. So when making a decision using the communitarian ethics approach, one has to ask a different question. And the question is, what are the demands or the duties that the community of which I'm part of make on me? What are the duties that the company expects me to carry out? What are the responsibilities? What are the demands of the team towards me? So the approach is not based on the individual, but on the community within which the individual is part of. So candidates, these are four fundamental approaches to ethical decision making. The utilitarian or outcome-based approach. So here we have utilitarians or consequentialists. There is the deontological ethics, which are duty-based. Then there is virtue-based approach and communitarian ethics. How many marks? These are 8 marks. Brief explanation would earn 8 marks per approach. So these are 8 marks plus 4 marks plus 8 marks plus 4, that's 12, plus 3, 15 marks. We've answered question number number 5. We are almost done with this sitting. In the next session, we'll answer question 6, then question 7. So thank you for your time. God bless you. Bye-bye.
Hello learner, welcome to Manifested e-learning platform. My name is F.A.M. Ngwiri and I practice within Kenya. Today, ladies and gentlemen, we are discussing about the financial modeling and data analytics August 2023 sitting. The question of focus is question 22. It reads as follows: Phoebe Nyamongo is analyzing bonds which have been issued in the Pesa exchange. The table below shows the 5 bonds under consideration. So we have bond 1 up to bond 6. So this should actually be 6 bonds, not 5 bonds. We've been given the issue date, maturity date, the current date, the years to maturity, fixed coupon rate, the implied yield to maturity, clean price and dirty price. You are required, A, to compute the modified duration for the bonds, number 2, the effective duration for the bonds, and the average for each duration measure. So we will move towards the right of our screen, right over here where it's indicated solution over here, and we shall be able to work it out there, the solution. So what I want, and with your permission, I can just highlight this, the same. I want the formats to be the same as we move right towards the right over here. So I'm saying that this is just what I want. I just want that to be, sorry, let me just undo that. Just put it like so. Then I just put borders. Borders like so. So here is where I want us to compute the modified duration. So we have modified duration. Like that. We'll put wrap text over here so that now it can be able just to be like so. Then we put Control B to bolden it. So for us to compute the modified duration right here, we will just need to click this function box or the function key here, and then we click on M duration. Click on M duration and we say OK. The settlement date is usually considered to be the current date, so we click that as the current date. Maturity, we fill out the maturity date, which is this one here. The coupon represents the fixed coupon rate right here. Click 10.8. But this has to be converted into percentages over here. So if we don't see over here convert into percentage over here as indicated right over here, we just escape and put it into percentage form over there. So we put percentage like so. That, and we can just put it in form of percentage. That, or just put it like so. Percentage. And we also do the same for all of them. So shift percentage like that, so that you can be sure that you're doing the correct thing. That and this. That. There's no adjustment that we need now. So we can come now again, click function argument or insert function. Click that. Settlement date, we said, is the current date. The maturity date is just indicated to us over there, 22nd April 2019. The coupon is that. You can see now we've indicated it in percentage form. That's better. The yield is the implied yield to maturity. So this also needs to be put into percentage form. So we have to redo that again. Percentage, because it's going to pick an absolute value. It's not going to pick the percentage as given to us by Kasneb. This is percentage, and finally percentage. So now we redo it again. Function argument, M duration. Settlement, we have the current date. Maturity, we put maturity date right there. Then the coupon, fixed coupon rate is 10 at percentage, 10.87. The yield, implied yield, is that form of percentage. And the frequency is semi-annual, 2. So we get 1.46. And because they are following each other, I can just double click moving down like so, and it will be able to just compute for us there. We also require to compute the average as indicated in the question here. So the average for each duration measure. So we just use the average function here, plus average. And we just highlight everything there and we close the brackets and we say enter. So that's the average. Put it red. Now we are also required to compute the effective duration. Effective duration. You can wrap text over here. Control B, bold. Once we have that, we can then compute the effective duration. Click the function button here. Duration, you search for duration. We go. You can see that represents the duration. So we say OK. In a similar fashion to the way we did it for modified duration, for macular duration, we select the settlement date, current date, maturity, select the maturity date right there. The coupon, fixed coupon rate is given to us there. The yield is given to us as the implied yield right here, and the frequency is semi-annual. So put 2 there, have that. So we autofill like so. And this, because they're following each other like that, I can just fill out like that, and that represents the average also for effective duration. Now we can then move on to part B, because we've computed the modified duration, effective duration, the averages for each of those 2 durations there. Assume that the nominal yield for the bond is 500,000. Determine the total purchase price for each bond and the total value of the bond portfolio. So we want to find out how much we would be able to spend if we were to buy bonds in the secondary market. So what we'll do, we'll put in here nominal value, that. So we'll just use text wrap, similar fashion here, nominal value. And we've been told 500,000. So we use the comma format. And we just drag it. And once we have 500,000, we can then also put here the purchase price. Price. Wrap text again, like that. So how much then would we be able to purchase the bond? If you've been given, say assume over here now the total value, so plus sum, you've been given, and this looks like, is it 3 million? Yes, 3 million. So the purchase price, so you can just also put it like so, right? So it can pick the same formula here. We want to see how much we would, if you've been given 500,000 to purchase bond A, let's see, would we purchase it at a premium or at a discount? The formula is, we will need then to click the nominal value, and then we multiply by the dirty price. Why the dirty price? Because we must pay the holder of the bond, because we want to acquire a bond from an individual who is selling. So we must pay the seller accrued interest. So we use the dirty price. So we must pay them accrued interest, and then we divide by 100. That's how much you would have to spend so that you can be able to buy bond 1. So for the other bonds, we would spend a total of, Control D, 2.837 million. So we would spend, if we've been given a budget from the investment committee of 3 million, we would spend 2.8 million to be able to acquire those 6 bonds there. Here we can put the comma format. And so once we've identified the purchase price for each bond, we can move ahead and compute part C. Assume as well the bonds pay semi-annual coupons. Calculate the total coupon per year for each bond. Per year, the keyword is per year. So we can move towards the right here and click over here, the coupons. Type here coupons. And for us to be able to compute the coupons, we will just need to multiply the nominal value times the fixed coupon rate right here. So nominal value, then we multiply with fixed coupon right there. Remember, we are saying that we want to identify the annual rate, the annual interest that is going to be earned. So if you want to know this, because bonds pay semi-annual payments, so if you want to determine how much you'd get in one of the payments, you'd pick this one and you divide by 2, because bonds pay semi-annual interest rate coupon. So we just divide by 2 to see the first 6 months period we get 27,175. The second period we get 27,175, totaling to a yearly, or the coupon payment per year, in terms of answering the question here. So we just fill that out, and you can be able to see the annual coupons that have been paid. With that, we can then move on to part D. Determine the running yield and the yield to redemption for the bonds, as well as the average for each. So the running yield measures the annual rate of return an investment provides. So what we can do then is to maybe elaborate it further. It is the annual income that you would receive from money you have invested in bonds. And so to calculate the running yield, we would have to come right here and put here running yield. Like so. Of course it has to wrap text like that, bold, Control B, that. We are saying we would need then to pick the fixed coupon rate, which is this. We divide it by the clean price, the price which excludes accrued interest, and then we multiply by 100. So this is the running yield. 10.98. And the various ones are presented to you there. For us to be able to get the averages, so we would click now average function. And that's what would happen. 12.5. So that represents average. Put it that color there. So once we have the running yield, which we've said measures the annual rate of return an investment provides, we can move on to the next question. determine the running yield and the yield to redemption for the bonds as well as the average for each. So now we need to do or discuss yield to redemption, compute it as well. So yield to redemption. Yield to redemption. And we are saying that this yield to redemption refers to the amount of money an investor will get back from a bond if they keep it for the full period agreed to when they bought it back. So that's what we're saying yield to redemption represents. And we are going to compute it as follows. We're going to add the running yield, or is given as the running yield. So we add, now we need to open 3 brackets like so. The 100, because bonds are issued per 100 value, then minus the dirty price, the price that includes accrued interest. Close the bracket there and divide that against the years to maturity. The years to maturity, not the yield to maturity, the years to maturity, which you're seeing is in that one over there. So we close the bracket right after that, and then we divide that again against the dirty price. That one there. Close the brackets. That's what we get, the yield to redemption. The amount of money an investor will get back from a bond if they keep it for the full period agreed to when they bought it back. So because it's the same format, we can just then sort of do it like that, and then we drag it down so that it can pick the formulas. We also need the average for this, so put it like so. And with that, then we can be able to now perhaps just, make it look, maybe beautify it like that, and see that now this is what the totals represent. And we can put a thick border outside down there like that, just to try and double check to see what we've actually done. We've done the modified duration, the effective duration, the averages for each measure. So the modified, effective, and the averages there have been done. Then we've computed the total purchase price. You can see the total purchase price is here, 2.83. We have also computed the semi-annual coupon rate, or to compute the total coupon per year, not per 6-month period. So per year, you can see the coupons have been computed to us over there. The next thing for us to do is to determine the running yield and the yield to redemption for each, as well as the averages, right there. So we've done that. The running yield and yield to redemption like that, the averages there. So then we need to draw a clustered column graph for the implied yield, for the average implied yield. So here we'll need to get an average plus average. And we're saying that just going to pick the average and highlight everything there, then we say enter. Perhaps I didn't select it well. Just a second. Or we can just get the sum of all of this. I'm not sure why it's refusing. Plus sum G7 to G21. So let me see if even if I am to ignore, so that one does not work. Doesn't change there. Doesn't change there. So what I can just do then is to just pick the values as the way they are, the implied yield to maturity, like that. So 11.5, 1, let me see, plus that value, like that. Let me see if it was just going to change the values like that. So those are the values given to us there. And now you pick the averages, the average, sorry. So it doesn't work, it doesn't pick. So I'm wondering what happens over here. Let's try it one more time. So average. So you can see it's clicked average. Number 1. And then you say OK. So it doesn't pick like that, even using the function argument. Perhaps maybe the format in which this has been given is also quite different. So what we can do, we can just then change this to be like so. Number 1, then we put here number 2, like that, 3, number 4, then number 5. You can see here it goes, continues, goes down, goes down. So number 5, so 1, 2, 3, 4, 5, 6. So you can put that. Then I say OK. So it must mean that there is a problem with the formula. So let me just put with the format in which, not that there's a problem with the formula that we've used. Let's just use now 11.5141. Just put it like that. So you can put percent now, sign like that. 41, so this one should be percent, like that. If it refuses, so like that. So then we put 12.1975%. It's summarized there like that, so it's picking now. Then 12.45, it's right here, 12.4502%. Then 12.6427, 6427, that. Then 12.9660, and finally 13.3452. 3452%, enter. So let's see the average function. It should pick now. So you can see now it picks. It must be a problem with the formatting over here. So let me just put that in red and bold it like that. So this is the average now. So I've just used the same. You see right here it's supposed to pick. It's not picking the formula there, but at least here we've managed to work our way around it. So you've been told to now draw a cluster column for the average implied yield, the average running yield, and the average yield to redemption. So the averages are also right over here. So if you, with your permission, I can just shift this or copy this for it to be side by side with these values here, like so. And now this one you can be able to say is the implied yield to maturity. So plus this implied yield to maturity, and of course we can be able now then to use format painter, make sure at least it looks presentable. So when drawing the graph for these three, it becomes easier now. So you can just pick those ones there and these values, the corresponding values there. So we come to insert, and then we come to recommended charts. So you can be able to see that we've actually been given the graph over here. So they told us to use a clustered column, and we've used a clustered column over here. So we've told to use cluster column, graph and implied yield, average running yield, and the average yield to redemption over here. So now here you can decide to even put chart elements. You can decide to put the percentages like that by clicking on this. You can leave it like that, or for someone to figure out over here. But with this graph you will not know what percentage is over here. So the best graph to actually use is this one over here. We can be able to see it's 12.15%, 12.5, and here is 12.52 for the implied yield to maturity. So the chart title over here can be the yields. That. And this brings us to the end of question 22. We hope that you have enjoyed being with Manifested Publishers, because we are here for you. Thank you and God bless you.
We want to do a question. On economic order quantity. Which you've said is the optimal quantity to do what? To order, so that you minimize the cost of what? Inventories, so that you minimize the cost of who? Inventories, EOQ. Please go to August of 2024. August of 2024. August of 2024. Question 2A. Question 2A. Saying actually question 3A, not 2A. Question 3A. Question 3A. Rahisi Supermarket uses different ordering policies to acquire its inventory. Due to uncertainty of supply of product X, the management accountant is evaluating the optimal order size for this product to set for the coming year. Relevant data on ordering policy is provided as follows. Order policy, units of product X ordered. Order twice monthly, you will order 500 units per order. Order twice monthly, you order 500 units per order. Order monthly, you're going to order 1,000 units per order. Order quarterly, you're going to order 3,000 units per order. Order semi-annually, you're going to order 6,000 units per order. Then order annually, you're going to order 12,000 units per order. It is ascertained that the purchase price per unit of product X is 500 for deliveries up to how much? 2,500 units. A 5% discount is offered by the supplier of product X on the whole order, where deliveries are up 2,501 up to 5,000 units. A 10% discount on total order for deliveries in excess of 5,000 units is guaranteed. each purchase order incurs fixed requisition cost of 1,200 per order. Carrying cost is 20% per unit per year, plus a 12% opportunity cost of the purchase price. The purchasing lead time is 3 weeks. Rahisi Supermarket is open 48 weeks per annum, and each year has 12 months. They want you to determine your economic order quantity. Let's start by analyzing our information. We know for us to determine our EOQ, we need our annual demand, which is 12,000 what? Units. You need your ordering cost per order, and your ordering cost per order is given by note number 4, where each order incurs fixed requisition cost of how much? 1,200. Your holding cost, note number 5, the carrying cost is 20 shillings per unit per year. So 20 shillings per unit per year, plus 12% opportunity costs of the purchase price. 12% opportunity cost of the purchase price. Then your purchasing lead time is 3 weeks. So lead time is 3 weeks, and lead time is simply the delivery time. There is a time it takes from when an order is placed to when it is received. Then your number of weeks in an year is how many? Is 48. And a year has how many months? 12. So let's start with the first part of that question. The EOQ. We say that this is a square root of 2 by your annual demand by your ordering cost. We divide by who? Holding costs. So this will be to an annual demand of 12,000 units by an ordering cost of 1,200. Divide that by 20 plus 12% of your purchase price. And your purchase price, which we have not indicated, your purchase price was given by note number 1 as 2,005, as 500 rather. It's 500. So therefore, what will be our EOQ? So the most optimal order quantity is 600 units. That is 600 what? Units. Number two, they are asking us to advise the management of Rahisi Supermarket on the optimal order size of product what? X. And the optimal order size of product what? X. Now, this company here can make orders at different times during the year. They can order twice, they can order monthly, they can order quarterly, they can order semi-annually, and they can order what? Annually. Different times, different quantities. So the organization of that company should therefore decide on the most optimal order size, such that this order size should minimize inventory cost. It should minimize inventory what? Cost. So when you're making this particular or your decision, or when you're going to advise them, we will advise them by considering the minimum total what? costs. Remember, one of the objectives of an organization is to minimize what? Costs. So that you maximize on your what? Revenues or your profits. So when you're making a decision here, it is important we determine our total costs, then we select the cost that corresponds to minimum what? Costs. Okay, so let's have this. So part 2, the optimal order size. Optimum order size. Order policy. You'll have your units of product ordered. This is Q, This is Q. So they have different quantities they can order. Then we need to get our total costs, which you know is your purchase price by your annual demand. Your annual demand by Q over OC plus Q over 2 by what? HC. You can order twice monthly. And when you order twice monthly, you will need to buy 500 units. You need to buy 500 units. We need to get the total cost when you order 500 units. And they were saying, it is ascertained that the purchase price per unit of product X is 500 shillings for deliveries up to 2,500. So when you order 500 units, your purchase price will be what? 500. Why? The price of 500 per unit is for deliveries of up to 2,500 what? Units. But our deliveries, which is our number of orders here, is currently what? 500. So how will this be? You're going to take your purchase price of 500. Your annual demand is 12,000 plus 12,000. Your reorder quantity is how much? 500. By your ordering cost per order, 1,200 plus 500 over 2 times your holding cost, which was 20 shillings plus 12% of your purchase price. But you know your purchase price is how much? 500. What will happen when you order monthly? When you order monthly, your reorder quantity or the quantity to order is 100 units. That means the purchase price will still be what? 500, because for the purchase price to change, you need to order more than 2,500. So this will be 500 times 12,000 plus 12,000. Now you are ordering how many units? 1,000 times 1,200 plus 1,000 divided by 2 times of 20% plus 1,200 plus 12% times 500. All right, that was monthly. Quarterly. Quarterly, how many units are you buying? 3,000. So you take 500. 500 is changing because now you're no longer ordering less than 2,500. So note number 2. Let's go to note number 2. That will change. Let's go to note number 2. A 5% discount is offered by the supplier of product X on whole orders where deliveries are 2,501 to 5,000 units. Now, since your order is between 2,501 to 5,000, you will be given a 5% what? Discount. That basically means that your new purchase price, let me indicate this, will be 95% of who? 500 plus times 12,000. That is your new purchase price. Why? Because we know a discount reduces your what? The purchase price. 12,000 divided by 3,000 times 1,200 plus 3,000 divided by 2 times 20 plus 12% of your new purchase price, which is after the what? The 5% discount. After the 5% discount. That was quarterly. Let's analyze semi-annually. Units is your order. With when your reorder quantity is more than 5,000, you'll be given a 10% discount. So this will be 10% of 500 times 12,000 plus 12,000 divide by 6,000 times 1,200 plus 6,000 divide by 2 20 12%. This should have been 90 of 90% of what? Of 500. 500. Remember, your purchase price is being reduced as a result of what? Discount. So if they give you a 10% discount, it means your purchase price will now be 90%, as captured there. Annually, you will order 12,000 units. Those 12,000 units, since they are more than what? 5,000, you still will receive a 10% discount. So 90% plus 12,000 over 12,000 times 1,200 plus 12,000 over 2 times 20 plus 12% of what? 90% of 500. 500. Why are we doing that? We are doing that so that we can base our decision on what? On the total cost. On the total costs. So let's now get our new total costs of each. We want to get the total cost of each. We want to get the total cost of each. This is 60, 48, 800. 58, 45 to 100. 58, 45 to 100. Right. Now, they were asking us to, or the student was required to advise the management on the optimal order size, and we've said we're going to base our decision on the minimum total cost. And in this case, the minimum total cost I can see is here. That is your minimum cost. So therefore, you're going to tell them to order how many units? To order semi-annually. 6,000 units. 6,000 what? Units. Then the optimal reorder level. Reorder level. We've also said this is your replenishment level. Replay. Level, or the level that indicates that there is need to buy inventories. We're going to say it is your daily demand by daily lead time. Your daily demand will be your annual demand of 12,000 . You divide by the number of weeks during the period, and the number of weeks during the period was what? 48 weeks. Then you multiply by your lead time, and your lead time was 3 weeks. So what you've simply done here is you've determined your weekly demand, then multiplied by your weekly lead time. So that means the level that will indicate that there is need to buy is how many units? 750 units. 750 units. All right. Now, we can also have another question where I want to show you what happens when you have more than, when you have a reorder discount. Already this is a discount, yes, but we can have multiple discount and single discount. So I want to make an extension to this particular question where you have a single discount, where you have a single discount.
Hello and welcome back to the lesson. In our today's session, we're going to continue with the topic boardroom decision making. We will study evidence-based decision making. By the end of this lesson, should be able to explain the various sources of evidence. The various sources of evidence. Now, the basic idea of the evidence practice, evidence-based practice, is that good quality decisions should be based on a combination of critical thinking and the best available evidence. You understand? The basic idea of evidence-based practice is that good quality decisions, good quality decisions should be based on combination of two things. Should be based on combination of one, critical thinking, and two, should be based on critical thinking and the best available evidence. The best available evidence. Not just evidence, but the best available evidence. And although all management practitioners use evidence in their decisions, many pay little attention to the quality of that evidence. The quality of that evidence. That's why I said the evidence should not just be any evidence, but it has to be the best evidence. And the result of that is that bad decisions based on unfounded beliefs, based on fads, based on ideas popularized by management gurus are made. And the bottom line is bad decisions. The bottom line is poor outcomes and limited understanding of why things go wrong. So evidence-based practice seeks to improve the way decisions are made, and it is an approach to decision making and day-to-day work practice that helps practitioners to critically evaluate the extent to which they can trust the evidence they use in making decisions. It also helps practitioners to identify, to find, and evaluate additional evidence relevant to their decisions. So evidence-based practice is about making decisions through the explicit and judicious use of the best available evidence. The judicious use of the best available evidence. And there are multiple sources of evidence. Sources of evidence. We are going to examine some of the sources of evidence. Why? Because before making an important decision, an evidence-based practitioner starts by asking, what is the available evidence? And instead of basing a decision on personal judgment alone, an evidence-based board or manager finds out what is known by looking for evidence from multiple sources. So what are the sources? What are these sources? Number one, scientific literature. Scientific literature. Now, scientific literature is comprised of findings from empirical studies published in academic journals, findings from empirical studies, findings from empirical studies published in academic journals, And this is the first source of evidence, which is scientific. We are talking about scientific literature. All right? And over the past few years, the volume of management research has escalated hugely, with topics ranging from evaluating merger success, the effects of financial incentives on performance to improve employee commitment and employee recruitment, and governance structure, corporate governance, and so on. And there is also much relevant research from outside the management discipline, since many of the typical problems that managers face, such as how to make better decisions, how to communicate more effectively, and how to deal with conflict, are similar to those experienced in wider range of contexts. We have scientific literature from psychology, all right, and other fields that are still relevant to management. And although many practitioners learn about research findings as students or on professional courses, new research is always being produced, which often changes understanding of managers. And in order to include up-to-date evidence from the scientific literature in board decisions, it is essential to know how to search for studies and to be able to judge how trustworthy and relevant they are to board decision making. All right? So that is scientific literature, which I've said that includes findings from empirical studies in academic journals. Then number 2, evidence from the organization. Evidence from the organization itself. All right, whether it is a business or whether it is a hospital or a government agency, organization evidence comes in many forms. It can be financial data such as cash flows or costs, or business measures such as return on investment, the market share, and so on. It could include the financial statements, the income statements, and it can also come from customers or from the clients in form of customer satisfaction, repeat business or product return statistics. It can also come from employees through information about retention rates or levels of job satisfaction and so on. And evidence from the organization can be hard numbers such as staff turnover rates. It can include medical errors, hard facts, hard numbers, as well as productivity levels. But it can also include soft elements such as perceptions of the organization culture or attitudes towards senior management and so on. And therefore, evidence from the organization is essential to identify problems that require managers' attention. It is also essential to determine likely causes, plausible solutions, and what is needed to implement the solutions. So evidence can also be gathered from within the organization itself. The third source number 3, evidence from practitioners. Evidence from practitioners. Now, this is the third source of evidence. All right? It is evidence from professional experience. It is evidence from judgment of managers, consultants, business leaders, and other practitioners. And candidates, different from intuition, opinion, or belief, professional experience is accumulated over time through reflection on the outcomes of similar actions taken in similar situations. And this type of evidence is sometimes referred to as tacit knowledge. Tacit knowledge, sometimes referred to as tacit knowledge. It is sometimes referred to as tacit knowledge. And professional experience differs from intuition and personal opinion. Why? Because it reflects the specialized knowledge acquired by repeated experience and practice of specialized activities. And many practitioners take seriously the need to reflect critically on the experience and distill the practical lessons. Their knowledge can be vital for determining whether a management issue really does require attention, and if the available organizational data are trustworthy, whether research findings apply in a particular situation, or how likely a proposed solution is to work in a particular context. Evidence from practitioners. The fourth source, evidence from stakeholders. Evidence from the stakeholders. Now, this is the fourth source of evidence, which is stakeholders. Okay? Now, stakeholders are any individuals or groups who may be affected by an organization's decisions and their consequences. Internal stakeholders include the employees, the managers, the board members. Stakeholders outside the organization, such as suppliers, customers, shareholders, the government, and the public at large, may also be affected. So, evidence from stakeholders is all about the stakeholder values and concerns. Stakeholder values and concerns. The stakeholders that I've mentioned have values. They have concerns. And the stakeholder values and concerns reflect what stakeholders believe to be important, which in turn affects how they tend to react to the possible consequences of the organization's decisions. So stakeholders may place more or less importance on, for example, short-term gain or long-term sustainability, employee well-being or employee output, organizational reputation or profitability, participation in decision-making or top-down control, and so on. Organizations, candidates that serve or respond to different stakeholders can reach very different decisions on the basis of the same evidence. And gathering evidence from stakeholders is not just important for ethical reasons. Why? Because understanding stakeholder values and concerns also provides a frame of reference from which to analyze evidence from other sources. It also provides important information about the way in which decisions will be received and whether the outcomes of those decisions are likely to be successful. So these are 4 sources of evidence which the board may rely on in making decisions. At the beginning, I said evidence-based decisions or decision making is all about making quality decisions, which should be based on combination of critical thinking and the best available evidence. So as a board member, as one who sits on the board, you ought to develop critical thinking skills. You need also to learn how to gather evidence from some of these sources I've mentioned, because there is always evidence or information from scientific literature, which is found in empirical studies in academic journals. You need to know how to search for the best, for the relevant data. You may also need to have skills on how to gather information from the organization, from the employees, from the clients of the company, and so on. You should also learn how to gather knowledge from practitioners, business leaders, industry leaders, the experts, the consultants, and so on. Skills are also required in gathering evidence from the stakeholders, the internal stakeholders, the employees, the managers, the board members, and so on. Or external stakeholders, the suppliers, the customers, the shareholders, the government, the members of the public, and so on. We've said evidence from stakeholders is all about the stakeholder values and concerns. Stakeholder values and concerns. We've said stakeholder values and concerns reflect what stakeholders believe to be important, which in turn affects how they tend to react to possible consequences of the decisions that could be made by the board. So that will bring this lesson to an end. Evidence-based decision making. Here is your assignment. Examine 4 sources of evidence needed for decision making by the board. Examine 4 sources of evidence-based evidence needed for decision making by the board. When answering the question, don't rely on your notes. Try and see if you can recall what we have learned in our today's lesson. Thank you. God bless you. In our next session, we will continue and we're going to study the cognitive bias. That is subtopic number 3, cognitive bias. Bye-bye.
Hello learner, welcome to Manifested e-learning platform. My name is FAM Ngwiri, and today, ladies and gentlemen, we are discussing about the financial modeling and data analytics paper which came in April 2023. The question in focus is question 22. It reads as follows. Let's read together. As a senior financial analyst at Wema Capital, you have been tasked by the chief investment manager to develop a financial model for a new startup company that plans to manufacture and sell electric bikes components in the country. The following information is provided. Number one, the company is expected to produce 1,000 units annually, 1 million units annually, pardon me. Number two, the unit selling price is expected to be 18.5 in 2024. The unit selling price is expected to increase by 5% annually. Number four, the cost of goods sold percentage of revenue is 42%. The salaries and benefits expense as a percentage of revenue is 17%. The annual rent and overhead expenses are 500,000. Number seven, depreciation and amortization percentage of property, plant and equipment or PPE is 25%. The interest rate percentage of debt is 10%. The applicable tax rate is 30%. Number 10, the accounts receivable days is 30. The inventory, number 11, days is 14. Number 12, the accounts payable in days is 30. Number 13, capital expenditures in year 0 is percentage of 15 million. It will be funded by debt issuance of 5 million and equity of 10 million. Required. Using Excel, A, prepare the following financial statements. Number one, the statement of profit and loss for the 5-year period. Number two, the statement of financial position for the 5-year period. Number three, the cash flow statement for the company for the 5-year period. B, we are told, undertake an analysis and compute the following financial ratios for the 5 years. Number one, profitability, that is the return on assets, return on equity, and net profit margin ratio. Number two, liquidity, current ratio, and quick ratio. So ladies and gentlemen, we can start solving this question on the on your right hand side over here of the screen. You can see the solution. So we move to the right over here and we start by creating the income statement or developing the income statement. So before we develop the income statement, the assumptions need to be created. So we write over here assumptions. What are these assumptions? The assumptions are provided to you right over here. And these assumptions will guide the 3 statements which you've been told to answer right down over here in part A. Statement of profit and loss, statement of financial position for the 5-year period, cash flow statement for the 5-year period. So we need the assumptions tab. And under the assumptions, we start now identifying the revenue growth rate over here. So we start by identifying, so you can bold this, Control B, there, that. And then here, we can start with revenue growth. That. The revenue growth will be moving for how many years? We're starting from year 2023 because we're assuming that that's the current year over here. So then we'll go now 2024 and moving ahead like that. So we put in the years right here. So 2023, 23 like that. Then we move on over here plus that one plus 1. 2024, and then we can go up to plus 5 years up to 2028. Just drag it like that. There. This, we can put it in bold, Control B, straight out like that, so it can be able to indicate the years there. So what have we been told for the revenue growth? We're saying the unit selling price is expected, or the sales or the revenue is expected to increase by 5% annually. Yeah. So we just put in terms of revenue growth in terms of right over here screen, we just put 5%. So first of all, like this, we highlight this section here, put percent. You can see percent is here, and you just put 5 like that. So the ones we've modeled the growth rate, come up with assumptions for the growth rate over here, Then we identify, of course, we can be able to now just say that that one is already done. Here we can perhaps maybe put it in red, but we'll put it in red when we develop now the income statement. And we've actually actualized the 5% annual growth. The next item is the units produced. The units produced, you can see, is right over here, note number 1 here. So you can write towards the right over here, units produced. Units produced. And with the units produced over there, we are saying that it's going to be 1 million. It's going to remain constant as at 1 million over here. So that. And of course, because we're going to put the comma format, come right over there, put the comma format. The accounting way of doing it, the financial analyst way of doing it is for it to have V0s like that. So just press Shift, Control R. It actually represents over here. And we're saying that this needs to be spread out very well. So you highlight and then you double click. That comes out like that. That is units produced. Then we can proceed on to compute the cost of goods sold, or the unit selling price is 18.5. You can put selling price, unit selling price, and it's 18.5. Remember, it is for the year. Remember, for year 2023, we may not have been given over here, but you're seeing from year 2024, the revenue growth should actually be from 2024 should be 5% and 1 million. So these ones should not be able to exceed. But in terms of the number of units not produced, but we're saying that the unit selling price in year 2024 is 18.5. So that one we should be able to include it right over here, 18.5 unit selling price. Selling price. Unit selling price. But here is 18.5. That. So we move ahead and we've already modeled these three right over here. The cost of goods sold, we need to model that. So we'll come up with assumptions. The cost of goods sold as a percentage of revenue is 42%. So we are saying it's going to be 42% moving ahead. So the cost of goods sold percentage of revenue, 42% there. So say COGS goods sold like that. So saying here it is G, the G should be small letters. Why? Consistency. That. So cost of goods sold, here we've been told that it, for 2024 is 42%. It should be 42%. So we put percent here, 42%. But we haven't been told whether it's going to remain constant right over there. That's now what we need to try and be able to identify there. So after that, the salaries and benefits expense as a percentage of revenue is 17%. So 17% remains constant, salaries and benefits. Fees and benefits. That. So just double click here, sort of like that. And we see it's 17%. Like that. But my assumption is the cost of goods sold, should remain constant like that. It only makes sense like that, so I'll just model it like that. The salaries and benefits should also be 17% across. They would have told us if there was any change in the cost of goods sold as well as the salaries and benefits. So here we're told is 17%. 17, I'll first of all put the sign like that. Here, then we just put it sort of like that. Salaries and benefits. Let's move on to the next item under the assumptions tab. So we've done those ones there. So the annual rent and overheads is going to be 500,000. That's annual, 500,000. Rent and overheads. And overheads, that is 500,000. And here it's not percent, so we put the comma format like that, 500,000. That, and we don't want it like that, we just want it to be, flat figure, that, and we just drag. So once we have the rent and overheads given to us there in the assumptions section, then we can move back to the question and identify the next item, which we're saying is depreciation and amortization. And this one is based on the percentage of PPE or percentage of pre-PE. So we come over here like this. And amortization. Like that, then put in brackets percentage of PPE like that. You're saying it's going to be how much, so we double click it like this. But here is, we can go back, let me just find out, it's 25%. So if it's 25%, so here we're saying it's going to be 25. But here remember, we need to sort of put it, so 25. And we shift, Control R, that's the assumption. We've not been told anything about the changing value of, depreciation and amortization in the terms of this rate. So next item, number 8 here, the interest rate as a percentage of debt is 10%. Interest. Sorry, pardon my spelling, interest. And you put in brackets over here, percentage of debt. Like so. Here we put it for consistency of PPE. Rent and overheads. So salaries, if I remember, let me just try and focus on it. Percentage of revenue. Yes, it should be percentage of revenue. And what else? Percentage of revenue. Let's see, cost of goods sold. Yeah, that's the cost of goods sold. Yeah, so it's percentage. Both of these, the cost of goods sold and salaries is percentage of revenue. That. So here I can say salaries, percentage of revenue. Shift percentage of revenue. That. This D should be capital. Right. And then this should also be the same. So this item should be copied. Percentage of revenue, like that. Oops. Percentage of revenue, copy. Percentage of revenue, close the brackets. Move on like that. Close the brackets. So once we have the interest on debt given to us there, we need to put in the values moving across over here. So the interest on debt, let me just try and recall right here. Note number 8, interest on debt, percentage of debt is 10%. So we put 10% moving across. Percent, and then Control R, like so. The next item is the tax rate. Should be 30%, flat figure there, tax rate. Is of course going to be as a percentage of earnings, yeah. Percentage of earnings. Earnings, that. So here, percentage of earnings should be 30%. We've been told 30%. 30, that. Then we sort of undo that. Control R. That's the tax rate. Then now we've been told something else about now the balance sheet items. I believe so. Yes, we've been told the balance sheet items in terms of the accounts receivable right over here. So the accounts receivable. Accounts receivable. And this should be in days. What have we been told? Let's go to the assumptions. To the question itself. Accounts receivable note number 10 is 30. The days is 30. So it should remain constant like that. So 30 days. This is not percentage. So we need to put the comma format. Like that. So we put 30 now. That. And of course, we do not want it in like that. So we shift that. Next item is inventory. Days is 14. Inventory days. Brackets days. And as usual, percentage like that we do not want. So we want to copy the format. Come to format painter. Come right there. Put it like so. So we put 14. Then we fill it in. Control R. So we're moving along. Inventory is 14. The accounts payable and capex has also been given to us there. Accounts payable. This is, of course, in days. So we've been told the days, how much, just to confirm. Note number 12, the accounts payable days is 30. It's 30. 30. So the comma format. 30, like that. Once we have the 30 there, we can then develop our assumptions for capex. Year 0 is 15 million. So 15 million. Capex. Capital expenditures. Capital expenditures. Here, what have we been told in year 0? Capital expenditure in year 0 is a percentage, and we're told it's 15 million. 15 million. It will be funded by debt issuance 5 million and equity 10 million. So total of these 5 and 10 should be 15 million. So we can now say that debt issuance it could be either issuance or repayment. When you repay debt, it becomes a negative value. When you are issuing, it becomes a positive value. So debt issuance should be positive, debt repayment should be negative over there. And then you've been told equity then we're saying equity is either issued or repaid. Repaid. So here capital expenditures, just to confirm, 15 million. So this is 15 million capex. So here should be 15 million because we've been told here 0. This is 2023 15. It's 15 million like that. So we just put the comma format, reduce the zeros. That. And then it will be financed by debt issuance 5 million and the equity 10 million. So debt issuance 5 million. And then here 10, that. So we have that given to us there. And what we can do now, because we have strict financial experts, we need to put the inputs to be in blue over here. So all our assumptions here should be in blue. So what we do, we just come over here, drop down window here, not this blue over here, let's go to more colors. Come over there, and we can be able to select a color such as that one there. Then we say, okay. That shows that those do not have formulae. You can change these values because these values will be tied towards the income statement. Now we come and develop down over here with your permission. Once we have the assumptions here, we can maybe perhaps decide to put it up to there to show that that's the maximum point where we are reaching. So we can put it in a different color over here and put it maybe say in a color such as that color there, faint blue like that. Then we come down. After the assumptions, we can come down and answer the first part of the question. Prepare the following financial statements. Part A, the statement of profit and loss for the 5-year period, statement of financial position for the 5-year period, and statement of cash flow statement for the company for the 5-year period. So we are going to do all the three. So statement of profit and loss is the first thing that we are going to do. And we start of profit and loss of profit and loss. Profit and loss, like that. So in a similar fashion, over here, we're going to just format painter because we want it to look the same up to there. Statement of profit and loss. How do we, what is the first element we start with? Revenues. So we start with revenue. That. We're not dealing with this current year revenue. This is just to give us a guide of the starting point we're supposed to start. But we are supposed to create a forecast based on the current values here. So what do? We just try to make sure that it's almost the same in terms of the format over here. Just try and maybe perhaps squeeze it a bit like that, if you don't mind. Double click. Like that. So from here, moving forward is what we're saying is going to be the forecast value. So what do? We put forecasts right over here. So even if we were to just drag it like that, 2023, and then we come over here and say field series, it's okay. But now we're talking about what? The forecast. F. Because these are not actual values. These are forecast values like that. That. That's more like it. This is the actual values of Y, but we do not really have the values here. But we are trying to focus based on the information given to us. So we come to revenue, and we can see we've been given the revenue growth as 5%. So we've been given the units produced and the unit selling price. So the unit selling price times the units produced will give us the revenue itself. So we come over here, plus the units produced, because it's a formula, units produced, you multiply with the unit selling price, and you enter. So what I want us now over here is, because this section moving down over here will be the accounting format, so I put that, and then I put 2 zeros like that, so that now it cannot disturb us now. So that is it. So how do we model now the years 2025, 2026, and so on and so forth like that? So we are saying that the growth rate is 5% moving forward. So it's pretty simple. You pick the previous revenue and you add a factor increasing the previous revenue by 5%. How do we do that? We multiply by 1 plus the 5%, this growth rate over here for 2025. Then we close the bracket and we enter. That's what it gives us. And if now we are to drag it moving across, it will give us the corresponding values based on the increase. That. Moving on, we can model now the cost of goods sold. Just pick cost of goods sold there. So cost of goods sold is a percentage of revenue. What I've done is I just put plus this item over here. That's what I've done. And that's why you can see it's written over here, plus C8. So it's just picking what C8 is. C8 over there, C8. So how do we model cost of goods sold? And over here we are told that the cost of goods sold as a percentage of revenue is 42%. So if you can put the formula over here, and margin center over here, if the formula for COGS percent is given as, and over here of course we're going to try and center it as much as possible, cost of goods is just given COGS over revenue. That. So this is the formula that you need to remember. Cost of goods sold over revenue. That. So if the cost of goods sold over revenue gives us 42%, so this is already the 42% which has been given to us here. We already have the revenue given to us. These are the revenues. Can we then get the cost of goods sold figure, which will be able to fit in right over here? Yes, we can. The COGS percent, the 42% moving across there, we multiply with the corresponding revenues, will give us the COGS. Hence, plus the revenue, which is this one over here when you cross multiply, then you multiply that with 42%, will give us the COGS of the cost of goods sold. And then you just drag it moving across. That. So we haven't been told anything that alters the cost of goods sold component. So we've just been told it is going to remain at 42%. So we can move on towards the right and continue by filling in what the gross profit is. There is no adjustment over here, so gross profit. And this, because it's a, it's a value over here. Remember, these ones have got formulas, that's why they are black in color. So we are saying we're just going to need to underline that here, and we say here we are getting them now as revenue. You subtract cost of goods sold, enter, get 10.7 million. Once you get that, you move sort of the formula towards the right. so that we can be able to get the solution. So now we talk about now the expenses over here. That, and you can be able to put it bold. So we start the first expense over here moving down as what? I may not remember. The first expense should be salaries and benefits. You can see up over here, salaries and benefits. So we put plus, we just go up to salaries and benefits there. Say enter. And for salaries and benefits, we are saying it is as a percentage of revenue, so 17%. So we can just change this formula. Percent. Salaries and benefits percent. Like that. Salaries and benefits percent is given as salary and benefits, salaries and benefits divided by revenue. So we have the revenue given to us there. It's this one which is moving across there. And we have the salaries and benefits percent. Can we get the salaries and benefits? Yes. In a similar fashion of the way we did the cost of goods sold is what we're going to apply right here. Hence, plus revenue multiplied by salaries and benefits percent. That. Move, Control R. So we also move ahead and talk about depreciation. Plus that value over there. So depreciation will be based on the PPE value. And hence, we may not be able to have the depreciation right away. We leave it like that. We proceed and identify what else we have. After depreciation and amortization, we have the interest. It's a percentage of debt. So, percentage of debt. We don't have the debt component given to us there. So, we just leave it like that. Those two items, we just need to leave it like so. We move ahead and compute the total expenses. So this one, we know because it's going to be, first of all, we'll need to get the total expenses like that. And then we'll also need to get this value like so. So it's just going to be plus sum. Let's see the sums over here. But the sum of what? Sum of these expenses right over here. So from here, moving down like that. You close the brackets and then you enter. So we move it like that. Remember, we've not filled in these values, so this value is likely to change here. You can be able to decide to put it in bold. Why? Because it's a total. And this we needed to also do the same. That. So once we've filled in what we've managed to fill in, we can move ahead and get earnings before tax. Before tax. So it's obviously going to be the gross profit, and then you subtract the expenses, the total expenses there. So you get the earnings before tax as that, and this should also be put in bold. So you can move like so. Then we skip a line and compute the component of taxes. There. Taxes we have been told what? Taxes right over here, we can move up over here. The applicable tax rate is 30%. So we can move over here. I'll put 30%. Close the brackets like that. So plus 0.3, that's 30%. Then you multiply that against that. Control R. What about net earnings? We're getting about the net earnings. Net earnings. Excuse me. So net earnings is just going to be based on, of course, this should be bold, Control B. That. So it's going to be plus, you get the earnings before tax, then we subtract the taxes. That. You get that value there. So we need to then copy the formulas moving across. Remember, we haven't filled in this part. If I can be able to use with your permission, so that you cannot be able to forget, I can be able to highlight something like that I've not filled that value, that part or that section. So that is our provisional statement of profit and loss. Provisional statement of profit and loss, because we've not filled in this part here. We move ahead and fill in the statement of financial position right down below here. So, of financial position. Or what is usually called SFP. Like that. So we use format painter. This is a similar fashion. That's what we need. So we start by identifying the assets. So that. And then we put in the first item over here of cash. We're just putting up items that are considered to be the assets. So we've combined the current assets and non-current assets. We'll be able to do that just for convenience purposes. So for cash, we haven't been given any item or any component on cash over there. So we can be able just to put that color there. So accounts receivable is the next one. Accounts receivable. So accounts receivable, at least we have some component on accounts receivable from the assumptions section over here. Accounts receivable days, we've been told, is 30 over here. And accounts receivable is tied towards revenue. So what is the formula for getting the accounts receivable days? So we can come over here, down over here, and just put it beside it over here. So this one, I just merge. So I can put accounts receivable. These are days. Like that. This is just a short form, please guys, note that. Is given as accounts receivable over revenue. That then times 365. Of course, this one can be just to merge at center, put it there, then you just put x 365. That's how you get it. Accounts receivable days is given as accounts receivable over revenue times 365. So once we know that, we can be able to model the accounts receivable, because that's what we want here. accounts receivable. We have the accounts receivable days. They are given to us up over here. Accounts receivable days, you can see they're 30. We also have the revenue given to us there, which is this is over here. So we have the accounts receivable days, we have the revenues, and 365 is a constant. Can we be able to model the accounts receivable? Yes. The accounts receivable is given as accounts receivable days, you multiply by the revenue, and then you divide by what? By 365. So let's do that together. So you pick the accounts receivable days, which are up here. Accounts receivable days, you can see them here. And then we multiply with the revenue, which is that. And then you divide by 365. We get that as our accounts receivable. But we do not want decimals over here, guys. What we want to model based on complete values, complete figures. So what do? We apply that same formula moving across. We move on and see what are other assets. Inventory. So our inventory has also been given us in terms of days. Inventory days here, 14 days like that. But inventory is driven by the cost of goods sold, not the revenue, but the cost of goods sold. Knowing that, how do we model inventory? So, inventory days is given as inventory. Inventory, we divide by COGS, cost of goods sold, and then times 365. For us to be able to now model the inventory, which is what we're looking for right over here, we just get the inventory days, we multiply by cost of goods sold, then divide by 365. Hence, inventory days, then we multiply with the cost of goods sold, which is this one here, and then we divide by 365. Move ahead and sort of apply the formula moving across. That's what we're getting. Thereafter, we can model other items that are related in the assets over here. So because we can see that we need depreciation over here, it goes without saying that we will need to compute something inclined towards property, plant, and equipment, PPE. So we can be able to have property, plant, property, and equipment. And equipment. So this we will need to have what is called perhaps maybe a depreciation schedule so that we can be able to fill in this value here. The moment we have the property, plant, and equipment, then we'll be able to also fill in the depreciation over here. So just in a similar manner, we just leave it like that. We'll be able to come and fill it later on. So anything that is pegged on the assets or the creation of financial statement or financial position does not exist. And so we can be able to just come over here and maybe sort of create a sum part or a summation right here. You can say total assets. That. So this needs to be bold, put in bold. Sorry, Control B. So that means it's just going to be plus sum, since this value here, of what? All of these values given to us there. Enter. So here, of course, we do not need to have something like that. So it's like that. So once we have the total assets given to us there, we now look at liabilities. So as for modeling the liabilities, pardon me, we Control B, yeah. We'll need to identify what liabilities exist based on the income statement of these assumptions here given to us here. Depreciation, we will need a depreciation schedule. The interest, we need an interest schedule. The tax, we'll be able to create a tax schedule. The accounts receivable, the inventory, we've already modeled these two. Now it's accounts payable over here. So the accounts payable and an element of debt, because we're talking about interest on debt. So the debt is also going to be a component that we'll need to put in as part of our liabilities there. So we start by identifying accounts payable. Accounts payable. And the accounts payable has got a similar formula as this, as inventory days. So we can just alter this. Accounts payable. It's got accounts payable. This is, of course, in days, please. That. Accounts payable days. We can just put accounts payable. Payable. Divided by cost of goods sold times 365. So for us to get the accounts payable, which is what we're looking for over here, we can just get the accounts payable days times cost of goods sold divided by 365. Let's do that together. So the accounts payable days is up here in the assumptions tab. Then we multiply that against the cost of goods sold and divide against 365. So we do not want decimal points. So we can just scroll down here. That. We drag. Control R. We mentioned something to do with debt because there's interest on debt. Debt. And this part for debt, we will need to create a schedule that is going to talk about debt here. So here we're going to just put, just going to put it into a gray to show that we're going to fill in that later on because we don't have that value of debt. So if that is the case of debt here, we can then just come over here and see the capital structure. The capital expenditures is 15 million. Debt issuance and repayment, debt we have as 5 million. You can see the debt is 5 million here. So if debt remains at 5 million, that is going to be a constant amount moving across. So just come over here, put plus 5 million. But if we put it 5 million across that, so it should remain something that we're going to put like that. And hence, we should now drag this moving across. Control R. So the interest on debt is 10%. So if the interest on debt is 10%, so how much then can we say our interest is? We go back now to the income statement. You see what I was saying? That we need now to start filling in these values. It's as a percentage of debt. So we can say is plus 10%. Is it 10%? interest on debt, you can see it here, interest on debt, multiplied by the debt component, 500,000. And of course, obviously, now it means that we're going to now change the color because we already have those items given to us there. That item. See, it just changes our income statement instantly and it will just fill in these values very well. We're not done yet. We need to get the depreciation component here. So we move ahead. Once we have the debt, there is really nothing else that we are going to, that we really need over here. So we just get the total. So if we have that, so I don't think there's any need for us to put it now in gray here. Just put it in form of a summation. And we just talk about what? Total liabilities. Total liabilities. So we have just plus to add them together. We just have to add them together. Sum like that and enter. So we now then apply the formula across, Control R, and we bold because that value, because it's a total, Control B. That's the total liabilities. So we are not done with the statement of financial position. We need to have that element of shareholders' equity. So there's what we call the equity capital, which we've been told the equity has been issued as 10 million. Remember, the debt remains like that. So it also goes without saying that if the debt remains constant like this and the total capital expenditures is 15 million, so it also means that, guys, you're going to just add this component, that Control R, remains as 10 million. So if that's the case, then we can be able to fill in the shareholders' equity section just down below it. Shareholders' equity. Equity. Shareholders' equity, just pick it from the assumptions section. There. That's what it's called, equity, shareholders' equity. And we just put it like so. But the shareholders' equity is a combination of many items. So this should be shareholders or equity capital. Yes, it should be equity capital. Pardon me for that. It's equity capital, not shareholders' equity. So this, I should just cut, Control V, comes like that. This is a title, so it should be bold. Do we have anything else in equity capital? The only item perhaps is retained earnings. Retained earnings. Earnings. Retained earnings there. So as far as the retained earnings is concerned, we are seeing that we're just going to pick the previous retained earnings, which represents the net earnings over here from the previous year. We don't have it, plus this value. So that you can pick the formula. Remember, there's something that is missing over here that we've not filled in. We're going to fill it in as we move along. So we can say that to calculate the retained earnings, it is the previous retained earnings plus the current earnings, net earnings over here of that value over there. And we enter. So we drag that formula moving across. That's what retained earnings is. The previous retained earnings for the year, this year was 2023. Then we add the current net earnings component over here of 4.959, but it's going to change because once we fill in this value here. So we get the previous value plus the current earnings like that. So this one will be previous value plus the current net earnings, you can see here. So the formula will just change as we fill in these items, this item for depreciation to change. So we can come back down here and concentrate now on identifying the shareholders' equity.
Hello candidates, it's my pleasure to welcome you once again to Manifested e-learning platform. We continue with the topic Introduction to Public Sector Accounting. The subtopic is Regulatory Structures and Oversight in the Public Sector. And today we are going to take on a new regulatory structure, which is the Directorate of Accounting Services and Quality Assurance. The topic is Introduction to Public Sector Accounting. The subtopic is regulatory structures and regulatory structures and oversight. The regulatory structures and oversight. Under regulatory structures, we have covered the International Public Sector Accounting Standards, which works under the auspices of the International Federation of Accountants, and the Public Sector Accounting Standards, which was formed and established by an Act of Parliament, which is the Public Financial Management Act of 2012. Those are two regulatory structures which we have discussed. In our today's lesson, we are going to focus on the third structure, which is the Directorate. The Directorate of Accounting Services. Your syllabus, if you read your syllabus, it says the Director of Accounting Services. That is the one who heads the Directorate. The Directorate is the office, and it is the Directorate of Accounting Services and Quality Assurance. And Quality Assurance. Quality Assurance. So, this is another regulatory structure. Now, candidates, the Directorate of Accounting Services and Quality Assurance is headed by a Director General, okay, who reports to the Principal Secretary, National Treasury, and the directorate. This directorate is organized into 4 technical departments, each department being headed by a director. So let's put down that I've said that the Directorate of Accounting Services, the Directorate of Accounting Services and Quality Assurance. This office, the Directorate of Accounting Services and Quality Assurance, is headed by a Director General who reports to the Principal Secretary, National Treasury. Principal Secretary, National Treasury. And the directorate is organized into four technical departments. Each headed by a director. So there are four departments under the Directorate of Accounting Services. If I may just do a simple diagram where we have the directorate at the top here, the Directorate of Accounting Services, the directorate. So you can have, this is the directorate. Then I'm saying below this directorate there are four technical departments. This Director General heads 4 technical departments, and these departments are one is the Government Accounting Services, Government Accounting Services. The second department is the Internal Audit Department, Internal Audit Department. The third department is Financial Management, Information Services, that is the IFMIS, the famous IFMIS. financial management information services. Then the last department is this sub-county national treasuries. Sub-county national treasuries. Sub-county national treasuries. So these are the technical departments under the Directorate of Accounting Services. Directorate of Accounting Services. 4 technical departments. And each department is headed by a director. That's why the one at the top here is known as the Director General. Director General. We have specific generals for our directors. You have the specific directors heading each and every technical department under the Directorate of Accounting Services. Accounting Services. And I've said the Director General reports to the Principal Secretary of the National Treasury. National Treasury. So these are the structure of the Directorate of Accounting Services. Now, how about the functions? The functions. Candidate, the functions of the Directorate of Accounting Services and Quality Assurance are myriad. They are myriad, meaning there are many functions. They are not 2, they are not 3, they are not 4, they are not 10, they are not 15, they are not 17, but there are 19 functions. 19 functions that are to be performed by these technical departments. And I'm going to highlight these functions. You're supposed to know all the functions because you are able. The good thing is that these 19 functions are written in English language. So candidates, I'm going to highlight the functions which, as I've mentioned, are expressed in English language, and the functions are self-explanatory. Self-explanatory. For example, function number 1, one function of the Directorate of Accounting Services is the designing and prescribing an efficient financial management system for the national and county governments to ensure transparent financial management and standard reporting. Function number 2 is in regard to legislation and oversight of financial and accounting policies. Number 3, promote transparency, effective management and accountability with regard to public finances in the public service. Number 4, development of appropriate policies and procedures to guide the internal audit function. Number 5, in consultation with the Public Sector Accounting Standards Board, ensure that uniform accounting standards are applied by the national government and its entities. Number 6, developing policy for the establishment, management, operation and winding up of public funds. Number 7, assisting county governments to develop their capacity for efficient, effective and transparent financial management in consultation with the Cabinet Secretary, Planning and Devolution. Number 8, establish systems for ensuring proper management, control and accounting for the finances of the national government and its entities. Number 9, coordinate the preparation of annual appropriation accounts and other statutory financial reports of the national government. Number 10, consolidate reports of annual appropriations accounts and other statutory financial statements of the national government and county governments and their entities. Number 11, develop accounting standards, reporting guidelines, and undertake research in identified areas of financial reporting. Number 12, initiate legislation and oversight of internal audit standards and policies. 13, customization and rollout of IFMIS across government and counties. Number 14, develop effective interfaces with other PFM and e-government systems. Number 15, issue guidelines to national government entities with respect to financial matters and monitoring. 16, undertake research to inform policy development. 17, facilitate budget implementation. Number 18, Secretariat to Public Sector Accounting Standards Board. That means that the Director of Accounting Services is the Secretary to the Public Sector Accounting Standards Board. And lastly, liaise with the Controller of Budgets and Auditor General on public financial matters. So those are 19 functions that are performed by the Directorate of Accounting Services, which we have said is organized into the 4 technical departments. No wonder the functions are many, because there are functions which are in relation to the government accounting services. Some of the functions that we have highlighted are in relation or are performed by internal audit department. Some functions are performed by the Financial Management Information Services, the IFMIS, and some are performed by the sub-county national treasuries. So thank you, candidates, for being attentive in this class. Today we have focused our attention on one regulatory structure, which is the Directorate of Accounting Services and Quality Assurance. Thank you and bye-bye.
Thank you for watching this video. Don't forget to get yourself a copy of our professionally prepared study text and revision partners.
Welcome to Manifested Publishers. My name is Mr. Mariga, and I will be teaching you Advanced Management Accounting. And we are continuing with the previous lesson, or the previous topic of budgetary control systems. And today, I want us to talk about budgetary control systems. I want us to talk about budgetary control systems. Now, budgetary control systems are systems put in place by the management of an organization when they are preparing budgets. Remember, these budgets are prepared with the main intention of showing you future expected performance, since they act as planning tools. So budgets here are planning tools, which must be prepared by the management, and they must be in line, or by the organization, and they must be in line with the strategic goals of that organization. We have various budgetary control systems that an organization can use. Number one, we have a top-down budgetary control system. Now, a top-down budgetary control system is a control system whereby the management of an organization prepares the budget, then it gives the lower level managers or the subordinates, but mostly the lower level managers, to implement the what? The budget. So this one is prepared by top level managers in line with the strategic decisions or the strategic plans. Then it is passed on to the lower level what? Managers for implementation. The opposite of that top-down budgetary control system is what we refer to as bottom-up. So the second one, a bottom-up control system. A bottom-up control system is normally done what? Is a budgetary system where budgets are prepared by lower level managers and they are passed to the top level managers for verification, for analysis, to see that they are okay. Okay, bottom up, bottom up system. Lower level managers prepare them and pass them to the top level what? Managers. It is the exact opposite of top down. Top down is said it is the upper level managers who pass it to who? To lower level who? Managers. So bottom up is the exact opposite. Now here the lower level managers are preparing and doing the necessary actions and passing it along to the who? To the top level managers. The third budgetary control system is a rolling budget control system. A rolling budget control system, just like the name suggests, it is a budget that is continuously updated by the user by adding a further period. So this rolling budget, there is continuous what? Update by adding a further what? A further period. Okay, rolling what? Budget. Then the fourth control system of a budget is zero-based budgeting, which we refer to as ZBB. Now, zero-based budget are budgets prepared here from scratch or from zero. So this one they start from scratch. So you do not use previous information when you're preparing these what? Budgets, and that is why they are referred to as zero-based what? Budget. As zero-based budgets. The fourth, or rather the fifth budgetary control system or method of preparing budgets is activity-based system. Good. Or ABB. Now, activity-based budgeting here, budgets are prepared by looking at the activity. So here you look at the activity and the cost driver. So you look at the activity and the cost driver. The cost driver we normally say is the cost of the activity being undertaken. The cost of the activity being undertaken. What costs it to be undertaken? That is what we refer to as activity-based system. It is almost very similar to when you talk about what? To this particular topic, when you are talking about overhead costing in intermediate level. When we talked about overhead costing in intermediate level, we talked about activity-based costing, where again you identify your activity and the reason why that activity was undertaken and the reason why the activity was undertaken. The fifth budgetary system, or the fourth budgetary system, is an incremental budgetary system. Now, incremental budgetary system normally looks or prepares budgets by increasing revenues and what? Costs. By increasing revenues and costs of the previous what? Periods. It is the exact opposite of zero-based what? Budgeting. Zero-based budgeting, if said, you start from scratch. See if you've not prepared it again. So, but this one here, what you're simply doing is increasing the revenues and cost of previous what? Budgets. The revenues and cost of previous budgets. To incorporate the changes that will do what? Will take place during the what? The period. This is also known as traditional system. It is also known as a traditional system of preparing of what? Budgets. Of preparing budgets, where you simply increase or incorporate changes to the previous what? Budgets, so that you can get new what? Or have new what? Budgets. Now those are the various applications of budgetary control systems. Of budgetary control what? Systems. So let's just recap them. We said this is prepared by top management, or it is looked at by top management, then passed to the what? To the lower management. This is prepared by lower level management, and then taken to the top management for them to check. Then your rolling budget, you increase a period here. Date is increased here, where you now open a new what? A new period. Zero-based budget, if said you prepare your budget based on from scratch, where you don't have previous information. Then activity-based budgeted, we've said identify the activity and the cost driver. Then incremental budgeting or traditional system is basically you incorporate changes by increasing previous budgets, previous period budget. Previous period what? Budgets. Previous period budgets. Those are the various what? Budgetary control systems that an organization will tend to use. So far we've come to the end of this particular what? Topic, which is topic 7, like your syllabus, and these are the items we've covered. So in this topic we've talked about applications of budgetary control system, which is also there. We've also talked about use of operational variances. Yes. In reconciling operational, or rather original with actual, original with actual performance, with actual performance. We have also talked about advanced variance analysis. We have talked about your ex post variances, which are planning and operational variances. that we have covered successfully. Your applications of learning curve. And ABB or ABC invariance analysis. And lastly, investigation of who? Investigation of who? Variances. All right. That is all that the syllabus requires you to understand as far as variances are concerned. So from me and on behalf of Manifested Publishers, goodbye and God bless you, and see you next time.
Part C reads, using 5 of Mintzberg management roles, discuss how the managers of EL could improve their performance. Mintzberg, this is C. Mintzberg's management roles. Mintzberg's management roles. Mintzberg's management roles. The question is, using 5 of Mintzberg's management roles, discuss how the managers of EL could improve their performance. The first obvious role is the leader role. The leader role. A leader is one who influences the subordinates to achieve organizational goals. The leader is responsible for the motivation of subordinates, because you can only lead through motivation. The leader is responsible for training, is responsible for staffing. The leader also carries out associated duties. The leader has a role also of building relationships with employees and communicates with and motivates and coaches the employees. So this company could have used this leader role to motivate, as you've seen. For the setting leadership style to be successful, the employees must be motivated, they must be competent. Competence comes through training, comes through coaching, comes through guidance. So the leaders of this company must have had training programs, seminars and all that, in order to influence and motivate workers towards achievement of organizational goals. There is also the entrepreneur role. The entrepreneur role. So an entrepreneur searches the organization and its environment for opportunities. Entrepreneur also initiates improvement projects to bring about changes. For example, we may have the organizing strategy and review sessions to develop new programs and provide guidance. We read about this manager helping in the design. He was passionate about design. We read how he visited the labs. So the management could have used this role to continuously improve the quality of the products and so on. The entrepreneur, we know, also acts as an initiator. An entrepreneur may act as a designer and an encourager of change and innovation. This is a kind of leadership that could have led to the success of this company by way of using Mintzberg role of entrepreneurship. Mintzberg also came up with the role, the monitor role, to monitor. That is a management's role, monitoring. That is seeking and receiving wide variety of internal and external information to develop thorough understanding of the organization and its environment. That's the work of the management. It also entails getting involved in the job of the employees, because you can only understand the challenges that employees have by trying to do the work that they do. And that is what this CEO, we read, that this CEO was also passionate. He delegated his some of his duties in order to visit the labs, in order to sit with the employees so that he could understand the products. He could also approve prototypes in the laboratory and so on. That is a monitor role. The manager is also a disturbance handler. Disturbance is a disturbance handler, meaning that a manager is responsible for corrective action when organization faces important unexpected disturbances. For example, organizing strategy and review sessions that involve disturbances, that involve crisis, and so on. So the disturbance handler takes corrective action when the organization faces important or unexpected difficulties. Then there is the liaison role. Liaison role from the word liars. From the word liars. Liaison. Liaison role. This involves maintaining self-developed network of outside contacts and informers who provide favors, informers who provide information, and so on. It is a management that has a role of networking, finding out partners, finding out contacts, important contacts that could help the organization to secure contracts, and so on. So these are some of the roles. There are many roles that we studied under Henry Mintzberg, but the question required candidates to explain five roles. 1, 2, 3, 4, 5. 5 marks or 10 marks? 10 marks. 10 marks. We've done A, B, C. I'm now going to answer part D, which reads, at EL, prospective executives went through an executive development program. I repeat, at EL, prospective executives went through an executive development program, examined 6 ways of leading and action logics that could have been included in the program's curriculum. D. That's the question, how leading and action logic could have been included in the training executive program, in the executive development program. That is, at EL, prospective executives went through an executive development program. Prospective executives. That means that before these executives were employed in this company, they had to go through an executive development program, and that information we get in the last paragraph, which says that during his second tenure as the CEO of EL, The company experienced transformational change due to the implementation of guiding principles for change in the organization as well as breakthrough in new technologies. Modi was a leading change management proponent, and he significantly contributed to EL's structuration of business model, philosophy, and business approach. As a transformational change agent, Modi introduced an executive development program where prospective executives of EL were trained on interpreting their surroundings and reacting when their power or safety was challenged. At EL, it was generally agreed that what differentiates leaders is not so much their philosophy of leadership, their personality, or their style of management, rather their internal action logic. Then the case goes ahead to define action logic. Action logic. And the definition is, it is how leaders interpret their surroundings and react when their power or safety is challenged. So before these potential executives were absorbed in this company, they had to undergo an executive development program where the training was based on action logic. All right? Leaders are trained on how to react in response to power challenge, because executives are persons with authority, with power. Now, when an executive's power is challenged in that environment, how should a leader interpret and how should a leader behave? How should they maintain and protect themselves against threats? It is the way we make meaning of ourselves, the way we make meaning of our relationships and the wider context, which then determines our behavior in both business and everyday life. Now, the question is, going back to the question, we defined action and logic, but the question is, so what are some of the ways that this company could have included in the program's curriculum? And these are potential executives. These executives, in my view, should have been subjected to a form of evaluation based on action logic. And under these action logic, there are different categories of leaders. The first one being the opportunists. Opportunists. So the executive should be trained under action logic. Now, who are these opportunists? These are leaders that are characterized by mistrust. Mistrust. These are self-centered leaders. They are characterized by egocentrism. Egocentrism. These are leaders who are characterized by manipulativeness. They manipulate others. Manipulativeness. The manipulators. And they tend to focus on personal wins. They focus on personal wins. They put their interests ahead of any other person's interests. They focus on personal wins and they see others and the world as opportunities to be exploited. And therefore, their approach to the outside world is largely determined by their perception of control. That means how they react to an event, how they react to an event depends primarily on whether or not they think they can direct the outcome. These are kind of leaders who treat others like objects or as competitors who are also out for themselves. The fact that he is an egocentric person, these kind of leaders think that everyone else is egocentric. And somehow, the opportunists tend to regard their bad behavior as legitimate. They are kind of leaders who reject feedback, they externalize blame, they retaliate harshly, and so on. So when training this executive, it's important that the program highlights some of the features of the opportunists within the program so that the company can also know the kind of executive that they are bringing in. Are they opportunists or are they, let's move on to the second category, number 2, diplomats. Diplomats. Now, the diplomat makes sense of the world around him or around her. But this action logic of a diplomat can have extremely negative repercussions if the leader is a senior manager. And loyally serving the group, the diplomat seeks to please higher status colleagues while avoiding conflict. And this kind of action logic is focused on gaining control of one's behavior more than on gaining control of the external events or other people. And according to the diplomat's action logic, a leader gains more. All right? A leader does what? A leader gains more enduring acceptance and influence by cooperating with group norms and by performing his daily duties well. So in a support role or a team context, this type of executive has much to offer, and diplomats provide social glue to their colleagues and ensure that attention is paid to the needs of others. And diplomats are much more problematic in top leadership roles because they try to ignore conflict. They tend to be overly polite, they are friendly, and they find it virtually impossible to give a challenging feedback to others. So initiating change with its inevitable conflicts represents a grave threat to the diplomat. And he'll avoid it all possible, even to the point of self-destruction. Do you understand this action logic? Diplomats' action logic is overly polite, avoids conflicts, too friendly, is polite, and so on. So when training these executive, potential executives, included in the development program should be the diplomat action logic. I've described the diplomat action logic. I want to describe the third action logic, expert, the expert action logic. Now here we have the largest category of leaders, the experts. Now these experts, in contrast to the opportunists, who I said focus on trying to control the world around them, and the diplomats, who concentrate on controlling their own behavior. These experts try to exercise control by perfecting their knowledge. They exercise control by perfecting their knowledge. These ones are concerned with their behavior. These ones are opportunists. They manipulate. All right? They like controlling the world around them. These ones, they control their behavior. These ones, they they focus on control world around them. The diplomats, I say, they concentrate on controlling their behavior. They want to avoid conflict. They want to look nice. They are polite to everyone. But the experts, on the other hand, they exercise control by perfecting their knowledge, both in their professional and personal lives. Professional knowledge and knowledge in their professional life, like emotional intelligence and so on, and personal, professional and personal lives. Exercise control by doing what? By exercising knowledge. Do you understand? They exercise what we call watertight thinking. Exercising watertight thinking is extremely important to experts. And not surprisingly, we have many accountants, many investment analysts, the marketing researchers, the software engineers, and the rest of the consultants. They operate from expert action logic. They are secure in their expertise. They are kind of people who present hard data and logic in their efforts to gain consensus and buy-in for their proposals. And these kind of people are great individual contributors because of their pursuit of continuous improvement, pursuit of efficiency and perfection. But these experts, as managers, they can be problematic because they are almost completely sure they are right. Okay? They tend to view collaboration as a waste of time, and they'll frequently treat opinion of people less experts than themselves with contempt. though I mentioned they could seek emotional intelligence, some of them to some extent they neither desire or appreciate emotional intelligence. There was a question on emotional intelligence in this sitting. Emotional intelligence, which is the ability to assess, ability to manage one's own emotions and the emotions of others. So the experts do not pay attention to emotional intelligence. They don't appreciate emotional intelligence. That is the problem with having experts as managers. So these are the features of the expert action logic. So when taking the managers through this program, it's important to highlight some of these features. This can also help the managers to evaluate themselves, to understand where they lie as far as action logic is concerned. Let's move on to the fourth action logic. Number 4, achievers. The achievers action logic. Now, achievers have a more complex and integrated understanding of the world than do managers who display these 3 action logics: the expert, the diplomat, and the opportunists. Achievers are individuals who are open to feedback, and they realize that many of the ambiguities and the complexities and complex of everyday life are due to differences in interpretation and ways of relating. So they know that creatively transforming or resolving clashes requires sensitivity to relationships and ability to influence others in positive ways. They can reliably lead a team to implement new strategies that can run over to 3 or so years, and also at the same balancing the short-term objectives. And most of the times achievers clash with the experts, the preceding action logic. They find themselves clashing with the experts, because the expert, subordinate in particular, finds the achiever leader to be hard to take, because he cannot deny the reality of the achiever's success, even though the expert may feel superior. These are people who make things happen. They may not have as much knowledge as the expert, but due to the fact that they have a balanced way of looking at things. I say that they are open to feedback. That means they are people who are approachable, they are people who are admirable, they are people they easily relate with other people. Okay? They understand that what we call conflict or ambiguities or differences between people is as a result of interpretation and the way we relate. And they say that they are individuals who are sensitive to relationships, unlike the experts, who think that they have it all. And the two clash, because as much as the expert has all the knowledge, the expert can not deny the fact that the achiever in reality, makes things happen or helps the organization to meet the intended or the desired results. This is the achiever's action logic. They have an integrated understanding of the world. They have an integrated understanding of the world. They are open to feedback. Achievers. Yet another type of action logic, this is number 4, number 5, we have what we call the individualist. Individualist action logic. Now, this action logic recognizes that neither the individualist action logic nor any of these other action logics are natural. Neither of all of these ones, the individualist action logic recognizes that all these are not natural, but are constructions of oneself and the world. All action logics are not natural, but constructions. They are just constructions of oneself and the world. And what sets the individualists from the achievers is the awareness of a possible conflict between their principles and their actions. Awareness, the awareness of possible conflict between their principles, do you understand? And their actions, between their principles and actions. Possible conflict. They believe that there could be, or they are aware of the conflict between these two, their principles and the action. They could be having certain principles or moral principles and so on, but their actions do not match with the principles or their beliefs. And this conflict between principles and beliefs becomes the source of tension, becomes the source of creativity, and a growing desire for further development. These are individuals who tend to ignore rules which they regard as irrelevant. They regard rules as irrelevant, which often makes them a source of irritation to both colleagues and their bosses. These are individualist action logic. Moving on to the 6th action logic, strategists. The strategist action logic. Now, what sets the strategist action logic from the individualist is their focus on organizational constraints and perceptions. Organizational constraints and perceptions, which they treat as discussable and transformable. Now, whereas the individualist masters communication with colleagues who have different action logics, the strategist masters the second order organization impact of actions and agreements. The strategist is also adept at creating shared visions across different action logics. These are visions that encourage both personal and organizational transformations. And according to this strategist action logic, organizational and social change is an iterative development process that requires awareness and close leadership attention. So these are people who deal with conflict more comfortably than do those with other action logics, and they are better at handling people's instinctive resistance to change. And as a result, these strategies are highly effective change agents. Are highly effective change agents. They are highly effective change agents. Strategies are fascinated with the three, what we call the three distinct levels of social interplay. That is personal relationships, that is organizational relations, national and international developments. They are fascinated with that. So they are also highly effective change agents. It is their focus on organizational constraints and perceptions that sets them apart from the individualists. Then lastly, we have the alchemist. The alchemist. This is the final leadership action logic. It is the final action leadership logic. It is the final action leadership logic. Alchemists. Alchemists have the ability to renew or even reinvent themselves. They have the ability to renew and reinvent themselves. Renew and reinvent themselves and their organization in significantly historical ways. And whereas the strategies will move from one engagement to the next, the alchemist has an extraordinary capacity to deal simultaneously with many situations at multiple levels. The alchemist can deal with immediate priorities, yet never lose sight of the long-term goal. The strategies I may just be on the long-term goal, but the alchemist can simultaneously deal with both the short-term and the long-term. This is the last action leadership logic. So this company, the EL company, can include all these action logics in their executive development program for the potential managers. And when the managers are taken through these action logics, the purpose is to help them, first of all, understand their current level. Where do they operate at? Where do they operate at by the time they are starting the training or the development program? Then as they are taken through all these action logics, they can personally evaluate themselves. They can see where they are and how they can move or how they can correct their action logics. If he's an opportunist, then he will understand that he's an opportunist. He will also understand the misgivings of these action logics. This action logic, if he's a diplomat, he should also know the pros and cons and how to improve, because the purpose for any development program is to move the individual from point A to point B. And you can see, candidates, how the action logic that I've described here can help you also as a potential executive know how to maneuver and how to live with, how to operate in an organization setup. If you're an accountant, then most likely you are to be operating at the achiever's action logic, or the expert action logic. Are you the kind of a person whose joy and love and attention and concentration is just the perfecting of knowledge? And if so, what measures are you taking place to ensure that the drawbacks of this action logic you're able to surmount? Because you saw that the expert action logic, the experts may not be in a position to gel well with the rest of the team. These are people who disregard others' opinion because they think that they have all the knowledge. All right? So these are the suggested solution for that part. 12 marks, 6 ways. Opportunist action logic, diplomat action logic, expert action logic, achiever action logic, individualist action logic, strategist action logic, alchemist action logic. Any 6 action logics here would earn you the 12 marks. And that marks the end of the revision of the case study that was tested in April 2022. That was on Monday 4th. I hope you attempted this paper before coming to this session. If you did so, you can check the solutions against your solutions and see where you need to improve. For those appearing in the pending exams, we wish you all the best. Make sure you at least do 10 case study questions on your own before appearing in that exam. We have summarized case studies in our revision partners. You may use the revision partner to get the case studies, attempt the questions. The solutions are provided within the case study. Thank you once again. I remain truly yours, Philip Sagwa. Bye.
Hello learner, welcome to Manifested e-learning platform. My name is F.A.M. Lingwiri and I am a practitioner within the financial services industry in Kenya. Ladies and gentlemen, today we are going to discuss financial modeling and data analytics practical paper. The focus is on the pilot paper which came out in March 2023. So the section we're going to discuss is section 2, which has a total of 60 marks. Question 21 reads as follows. Jeff Mark, a potential investor from United Kingdom, is considering investing in a technology startup in Nairobi, Kenya. The investor has approached you as a financial analyst to perform a discounted cash flow valuation to determine the company's fair value. You have been given the following information. Number 1, projected revenue for the target company for the next 5 years, 5 million, 6 million, 7 million, 8 million, and 9 million respectively. Number 2, selling, general administration and other expenses is expected to be 45% of sales. Number 3, depreciation is expected to be 5% of sales. Capital expenditures are expected to be 450, 600, 750,000, 900,000 and 1 million in the next 5 years respectively. Number 5, changes in net working capital are expected to amount to 150,000, 200,000, 250,000, 300,000 and 350,000 in the next 5 years respectively. The startup has a cost of debt of 10%. The capital structure of the company is 30% debt, 70% equity. The company has an outstanding debt, that's note number 8, of 500,000. The net borrowing over the 5-year period is expected to be 0. We move on to number 9. The terminal growth rate is 5%. The risk-free rate is 7%, that's note number 10. Number 11, the expected market rate of return is 15%. Number 12, the industry beta is 1.5. The startup has a tax rate of 30%. The examiner is requiring you to calculate the free cash flow to firm, FCFF, value of the firm in Excel. So I will be able to work with you while we discuss the solution on my right hand side over here. So let's navigate on that side. So we start over here. The starting point is to determine the formula or to compute the formula. The formula for calculating free cash flow to firm is as follows. So FCFF, put it in capital, in caps, FCFF is given as, we need to compute the net income, and then you add non-cash charges. I shall be able to explain what all of these terms are. Non-cash charges, and then you add interest 1 minus tax, or what we can say is after tax interest expense. So interest brackets 1 minus tax T, allow me to put like that, can be able to just put it in full tax like that, and then you deduct the fixed capital investments FCINV, we'll denote it as that, FCINV, fixed capital investments, and then, ladies and gentlemen, we deduct the working capital investments, WCINV. So I will walk you, or we will walk together. I will put it in a columnar format over here where we're going to discuss all of these items over here. So we're being informed that it is a 5-year period. That should be our starting point before I actually explain what all of these terms are. So we are saying that we have the years, we can start from over here, year 1, moving through to year 5, right there. So we drag it like this for 5 years. Don't worry about that. In Excel, it might indicate like that, but you just click this button autofill here. So if you want to copy the cells, do you want to fill series? I want, or we want to fill the series. But there, you can clearly see it actually gives us a 5-year period there. So then we will walk through over here towards our left here by indicating the items over here that will lead us towards calculating the net income. So how do we calculate the net income? The net income is just the sales less cost of sales. You're supposed to get the gross profit, then you less expenses, you get the EBITDA, you deduct the depreciation, and then you deduct taxes to get the net income. So, ladies and gentlemen, for net income, we shall be able to compute it right away, because from the question we haven't been given what net income is. As for non-cash charges, this is just depreciation and amortization. And from the question, if we navigate back to the left over here, you can be able to see that we have note number 3. Depreciation is expected to be 5% of sales. So that one is well covered in the question. Getting back, we need then to identify the interest component. And this one we're looking at after-tax interest expense. This is important and needs to be added back because we are only interested in that interest component that is due to the bondholders. So we need to get the after-tax interest expense. Then we proceed on by computing the fixed capital investments. The fixed capital investments represents the capital expenditures. Every firm has to have fixed capital investments or capital expenditures in the sense that they need to buy equipment, they need to buy property, they need to buy plant, you name it. So that fixed capital investments, of course, you need to deduct the sale proceeds of long-term assets for you to be able to get the fixed capital investments. And from the question, we have been given that item. When I get to the left over here, you can see that we are provided with that note under note number 4. Capital expenditures are expected to be 450,000, 600,000, 750, 900, 1 million in the next 5 years respectively. Our next item is the working capital investments. So we navigate like back to the right. Working capital investments. This represents the change in working capital from one year to the next. So the change in working capital has also been provided in the question under note number 5 right here. The changes in net working capital are expected to amount to 150,000, 200,000, 250,000, 300,000 and 350,000 in the next 5 years respectively. So once we identify the inputs towards computing the free cash flow to firm, then we can be able to answer the question very well. So the starting point will be to try and determine the net income. The net income, we will start with the sales over here. Sales. And what is the value of sales? We can navigate back to the right over here, to the left, pardon me. The projected revenue for the target company for the next 5 years is 5 million, 6, 7, 8, and 9. There. So we navigate back here. 5. And remember what we said, we just drag that. If it's a sequence, then there's no problem. What did we say? We wait for these autofill options right over here, and we click here, and we can be able to click fill series. So it's not giving us the correct value over here, but if we do this, delete here, we put 6 million here, that, and then we now drag from the both of them over here like this, and you wait for that plus sign. Remember, ladies and gentlemen, wait for the plus sign like that. Then you'll be able to see now it auto-populates. Because we are financial analysts right here, we just click this comma sign over here. But 2 decimal places is too much for us, and so we reduce them using this decimal or this number format right over here. So we don't want to increase, we want to decrease it to now at least 5 million there. 5 million, 6, 7, 8, and 9 without decimal places. So the next item that we need to proceed on is to try and determine the cost of sales. From the question, I have gone through the question together with you, and we haven't seen anything or any item that talks about cost of sales. We only have selling general administration expenses under note number 2. Note number 3 talks about depreciation. Note number 4, capital expenditures. Number 5 talks about working capital expenditures. We don't really have any information about cost of sales. So what do we do with that? We ignore that component of sales, and we can be able to put it like so. So because financial analysts, in modeling, the first thing that we need to note is that we need to ensure that these colors for input values should always be blue. So we come over here and we can click a color right over here, so that now we can be able to ensure that those colors represent input values. Then less cost of sales, cost of sales, like that. Because it doesn't fit, no problem. We just double click when it's like that. We just double click, it will fit. Over here we put dashes over here, 0. That. So if you put zeros like that, shift, we move towards the right, and then control R, it comes. So we can be able to put now the comma format over here. Remember this over here, Alt, then we can be able to say that we want to H. Remember we are on home over here, so we home, then we come over here, so H, and then we want K. This K, you can see K represents the comma over there, so you click K like that, and it becomes dashes there. Remember, the color has to be indicative of inputs. Moving on, the spelling here is not correct. You can see cost of sales. So we proceed on with the next item. Sales less cost of sales, we get our gross profit over here. So gross profit, that. And we want to be specific to show that this is it's a sum, or you're trying to get a computation. This is an answer that you're getting over here. So what do? We can be able to put a top and bottom border over there like that. So it may not really be thick enough. So what do? We try and see if we can be able to put a thick bottom border over here like that. And over here I can decide to also put a thick bottom border like that, so that I can be able to pick and show that that is a solution. So you can see here. So it will be just plus that one, then we deduct that one there, we enter. It has to be black. So we are saying that we want to ensure that our decimal points are going to be the same. So that's what we do. And then shift so that it can autofill. Control R. This should be in bold. Why? Because it's an answer you're getting. And so from there we get the gross profits. Now we deduct expenses. So we can deduct expenses. We navigate back to our left over here. So this, with your permission, ladies and gentlemen, I can highlight this with a very soft color right over there to show that we've done that. Expenses. Talk about selling, general, administration and other expenses is expected to be 45% of sales. So we say, in short, allow me put S, G and A expenses. S, G and A expenses. So you can come over here, put S, G and A expenses. And we can see, we navigate back to our left over here, you can see it's what percent. Note number 2, selling, general administration and other expenses is expected to be 45% of sales. So we navigate back, 45%. So we put 45% like that. Then, of course, we do something like that. And we just directly plus 0.45 that times sales, that, enter. And you can see that we need then to move using the formula, you can just shift Control R. And you're saying that here we need to put blue sign here. That. Then we toggle back or go back and highlight this because it's already been done. Can highlight there. And we say that that is the pro forma EBITDA because there's nothing, no other expense that is over there. Other expenses has been factored in there. So you can say that that is the pro forma EBITDA. Pro forma EBITDA. EBITDA. What is EBITDA? Earnings before interest, taxes, depreciation and amortization. And we say that once we get the 5 million, we deduct this over here because these are expenses. Allow me then to put a negative sign so that we can be able to indicate that that is being deducted. That. So that is a negative sign. So Shift, it changes the sign. Control R changes the sign. So pro forma EBITDA, our pro forma EBITDA over here is going to be plus that, and then we add. We are adding because this is a subtraction sign or a deduction sign. That, go that, we get that. And then Control R. Because it's a pro forma EBITDA and it's a solution, it's an answer, so we bolden this. Control B comes immediately. After that, we are informed that there is another component here we need to deduct. Note number 3, depreciation is expected to be 5% of sales. Fine, that's what you have been informed. We just put depreciation here. Depreciation. And we can be able to indicate that it's 5% so that anyone who is looking at the model can be able to relate. 5%. And you're saying that it's just 5% of sales. That's what the question says. So we just put plus minus, just so that we can be able to get a negative sign like that. 0.05 multiplied by the sales gives us 250, like that. Control R. And we put blue color, like that. So what are we going to get after deducting depreciation? There's nothing to do with the interest. That's why we went directly to depreciation. Earnings before interest, taxes, depreciation and amortization. So we deduct the depreciation. And once we deduct depreciation over here, we can be able to get the pro forma EBITDA on taxes. Pro forma EBITDA on taxes. So that we can be able to deduct now the taxes thereon. That. And we just add them going down. Plus that, plus that. Get 2.5. Shift, move to the right, Control R. Remember one thing, guys. I want the format here to be the same as the one here. So we just put it like that. Format painter, put it over there like that. So it can be able to bolden. Once we have the pro forma EBITDA on taxes, we then deduct the taxes. So taxes. And what is the tax rate? We can just navigate back to the question right over here. But before we navigate, before we move down and see taxes, we can highlight this and say that this one is done. So here we have capital expenditures, note number 4. Note number 5, changes in working capital. The startup, note number 6, startup cost, cost of debt, 10%. Capital structure of the company, note number 7, 30%, 70 equity. The company's outstanding debt of 5 million. The net borrowing over the 5-year period is expected to be 0, so that one is not it. Terminal growth rate, risk-free rate, expected market rate of return 15%, industry beta 1.5, startup has a tax rate of 30%. So this one, ladies and gentlemen, we are going to use it several times, and so I do not want to highlight it right away. So we go back over here and say taxes here, we can put it in brackets here, it's 30%. 30%, then close the bracket. 30% plus 0.3 multiplied by that value, 750,000. So we then now complete the taxes part, Control R. That's what we get. The taxes are 30%. From the question, I can just check again if there is anything else we've left out. Projected revenues, selling general administration expenses, depreciation is expected to be 5% of sales. Note number 4, or information presented number 4, information given to us number 5. All these will be used up when we are computing the free cash flow to farm. So I can confidently say that we have used all items that give us the net income. So here, I can come back here and say that this is net income. Net income. And we're saying that the taxes right here should also be color blue. So the net income will be, we get the pro forma EBIT down taxes, we deduct the taxes which are at 30%. So plus that. And remember what we said, that this should be, because it's for consistency's sake, put it also negative. So you can put negative like that. Then you can just ensure consistency like so. Plus that, then we add the taxes. We're adding because essentially you are deducting right over here. So 1.75. So then Shift Control R. So what we do, we want to ensure consistency, so we bold that. Do Control B, and then we want to ensure that it shows that it's actually an answer that you're getting. So we come over here, we can just thick bottom border over there, and even this other one over here, you can also put a thick bottom border so that it can, yes, like that. So the pro forma EBIT down taxes, we also need it to appear like so, thick bottom border, and we want to ensure that it's also going to be the same as the net income. So you can come Format Painter and do the same right over here, that, and also the gross profit like that. So we have these titles over here: gross profit, pro forma EBITDA, pro forma EBIT down taxes, and net income. Once we've reached there, we go now on to formula for FCFF, our formula here. Highlight it in red. Our net income, we add non-cash charges. We said non-cash charges represent depreciation and amortization. And then we didn't have any information about interest, so we ignore it. And then we deduct the fixed capital investments, which represents the capital expenditures, and then we deduct the working capital investments here. So I can come just down over here after the extract of the income statement and say FCFF computation. FCFF computation, that bold, Control B. And we'll start from the net income over here. So net income, that, and we just pick the values right over here, plus this one. Enter. And then we just shift, move towards the right, Control R. We put this in bold because this is our starting point for FCFF. There. What is the next item? Our next item is non-cash charges, depreciation and amortization. We add that. So depreciation, non-cash charges, this is the depreciation over here, non-cash charges, that, put a hyphen on that, non-cash charges. Here we just add our depreciation here, what we got here. And we are saying that we will now get a positive value. We need to add back a positive value. So plus, minus that value. So that it can be positive, because we are adding non-cash charges, not adding the negative component. So we just fill that out towards the right. The next component for computing free cash flow to farm represents interest 1 minus tax. So we don't have any interest component in the question provided. So we move on to the next item, the fixed capital investments. And we are saying that the fixed capital investments will be the capital expenditures. So come down over here, fixed capital investments, fixed capital investments. So we don't want it to be bold, we want it to be like that. And then we move to our left here, we see what information we have towards fixed capital investments. We have capital expenditures are expected to be 450,000, 600, 750, 900 and 1 million in the next 5 years respectively. So we have 450, 600, 750 and the rest. So we have 450,000 right here.